One guest, Stanis Vamakidis, earlier this week, who said they'll be hiking into weakness, euro-dollar down to 105. That's not going to help inflation. And then you've got another guest, Lisa, George Saravelos, who was talking about breaking out into a positive regime and taking euro-dollar maybe back towards 130. I mean, if you don't know what policy is going to do to the FX channel, that's a tricky position to be in, isn't it?
It's a tricky position to be in, especially because regime change is not just isolated to what central bankers can do to support growth. Is the FX channel more reliant on what central bankers do with rates, or is it mostly the growth outlook, which is a new regime, this whole idea of trying to get a stronger currency to push down inflation? This is all turning the playbook of the past decade or two on its head.
I remember about 8 years ago, Mario Draghi of the ECB, Tom, at the time, the ECB president, said that rates need to be low now to be higher in the future. We're 8 years later, Tom, and we're still looking at negative rates in Europe.
One of our guests this week, Nora Rubini, with that accent, QE1, QE2, QE3, QE4. Rubini was dead on.
Was that the Nouriel accent?
No, I can't do the Nouriel accent. I need at least 3 beverages to do the Nouriel accent.
I'm not sure Rubini would approve of that accent.
And Barry in the background playing
I'm not sure what that was. Futures up 0.5% on the S&P. This is Bloomberg.
Save us, go to break.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden says Russian leader Vladimir Putin may have fired some of his advisors or put them under house arrest. He also said it's an open question whether Putin is fully informed on how his military is doing in Ukraine. The Kremlin says those remarks were a perfect example of disinformation. European Union leaders have a warning for China's President Xi Jinping. China will hurt its global stature if it helps Russia during the war in Ukraine. That message will be delivered in a virtual summit today. The warning will test Beijing's commitment to keep the war from damaging its ties with the EU. The U.S. is denying claims from Pakistan's Prime Minister Imran Khan that it wants him ousted. Khan's government has lost its majority in parliament, and he faces a no-confidence vote on Sunday. Now, Khan has had a tense relationship with the U.S. He hailed the Taliban's victory in Afghanistan and has not yet spoken with President Biden. The House has moved forward a key piece of President Biden's drug pricing agenda. Lawmakers voted to limit what insured Americans pay for insulin to $35 a month. Now it's up to the Senate, where a bipartisan group is coming up with its own insulin proposal. Big firms are ramping up their fee war across the $7 trillion U.S. marketplace. The latest shot was fired by BlackRock. It has just cut costs across a handful of ETFs, including the biggest bond fund in the industry. State Street and Vanguard cut fees last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you can tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I worry that the Fed now has to choose between one of two mistakes. I worry that they'll tip us into recession. That's what I worry about. That they are late, that they mischaracterized inflation for too long, they didn't do enough, and now they feel that to regain their credibility, they have to show, and they hiked twice by 50 basis points.
Fantastic to hear from Mohammed earlier this morning ahead of Payrolls Friday this morning. Good morning to you all. Futures are positive 0.5% on the S&P, on the Nasdaq up 0.5% also. As Mohammed El Erian pointed out, that is the view right now. 50 basis point move for the next meeting and another one after that. BNP, the latest one, to throw their name into the hat, Tom.
And John, what's great there, I've never seen the Hudson River look that beautiful. With for those of you on radio, the Hudson River just never looked that good, John.
I haven't seen the Hudson River with reefer boats going down it either, Tom. I think that was Lake Como.
Oh, you think so? Francie Lacroix, folks at Amberseti at Lake Como, we thank her for her frozanical work. It's quite cold there, as it always is, end of March, early April. Right now, on the spectacular success and good news of people like virologist Andrew Pekosh. He joins us from Johns Hopkins. We've had so many difficult conversations, and we do this now with an America with under a 7-day moving average, 700 deaths. That is a triumph of science. Dr. Pekosh, why can't they do that in China?
Well, it's a very different situation in China for a couple of reasons. I think one of the things is that they're using vaccines that are maybe not as durable and don't induce broad enough protection like we are using sort of here in Europe and other parts of the country. I think the second thing is China's strategies have worked really, really well against every variant prior to Omicron, but Omicron sort of changes the game. It makes a different playing field here, and the strategies that worked against other variants aren't working as well with Omicron, so they're now struggling to keep up with this more transmissible variant.
Dr. Pekosh, what are you hearing on the ground there, and what are the tea leaves that you're reading from where China is going with zero COVID?
Well, they seem to be committed to the zero COVID policy. I think this is going to really open up some opportunities for China to rethink their vaccination strategy and the vaccines that they use. It starts and ends with vaccines these days. The impetus to have a zero COVID policy with Omicron requires an even higher level of public health intervention. And so it's a question of whether or not that country can commit to even more restrictions to control COVID the way they've tried to control Omicron, the way they've tried to control other variants.
What would happen if they just allowed people to go about their business and really just got rid of zero COVID policies?
Well, you'd see a massive increase in cases there too, because again, I think the immunity in that population isn't as good because the vaccines they've been using aren't as good as some other ones. I think you would still be really weary about surges in terms of cases in hospitals, mortality rates among the elderly. All those things that we hear about here would be coming to bear in China, except where we were really worried about this over the past 6 months or previously. Now you've got China doing it, getting worried about it now.
For our listeners and viewers, I believe it was Delta with deaths under 900. We celebrated. We were wrong. Along came Omicron. How do people like you determine the next Omicron?
Well, let's start by saying, the general public here in the U.S. is got a little bit of reprieve right now. I'm cautiously optimistic about the levels of cases that there are and how long we'll be able to hold those. Public health officials, scientists like myself, we're constantly searching for variants that give us signatures that potentially they could be different from the circulating variant, Omicron in this case. And we're also looking for clusters of cases that are occurring that are localized to one geographic area, one town, one city, that might give us another sign that a new variant is emerging. Right now, nothing looks concerning on the horizon, but public health laboratories are still busy monitoring things and keeping an eye on things.
That's the last bit. I just want to hear that on repeat. Nothing concerning on the horizon. Doctor, thank you. Dr. Andrew Peckosh there of the Johns Hopkins Bloomberg School of Public Health, taking that into the weekend on repeat. One stock I want to look at is Alibaba in the pre-market. Bloomberg coming out with a story this morning, just a few hours ago. Chinese authorities are preparing to give US regulators full access to auditing reports on the majority of the 200-plus companies listed in New York as soon as the middle of this year. That story out, Lisa, a little bit earlier this morning. That stock up 7%.
And it follows news earlier this week. The SEC's Gary Gensler was actually taking a pretty hard line. How much was this sort of the peak of the negotiations that are leading to some concessions on the part of Chinese authorities? And how much does this play into the story that we're seeing with respect to COVID zero, with respect to the slowdown in the economy there, with respect to their need for financing amid so much turmoil, both internally as well as externally?
This line in our story, I think, is pretty interesting too. Tom, the government is prepared to accept that some state-owned enterprises and private companies that hold sensitive data will be delisted. We want to find out who those companies are.
Yeah, it's a back and forth. I mean, it's all there is to it. And I'm frankly of the thought here, John, that it is clouded by the war in Ukraine and by the relationship of China and Russia. I don't want to overplay that, but this article this morning is a real surprise. It would be a massive sea change.
If this is the case, I think it's really important. I think in many ways in this relationship, Tom, the US side have almost underestimated the value of being able to tap US capital markets. Of course, those companies that are listed here needed to do this. They should have been doing this years ago. And it's only very recently, Tom, that you've seen it ramp up again and ask them to do this. So I'm surprised it didn't happen in a bigger way before. We've tried for a long time to make this happen. It's important it's happening now.
I would agree. I'm going to keep my opinion out of it. I would agree. I just... On an accounting basis, it's been odd from day one.
It has never made sense, Lisa, that somehow a foreign company does not have to abide by the same rules as a domestic one listing in US markets. It has never made sense.
And the fact that it's taken so long to get some sort of concession on this with respect to disclosures and to see who they don't want disclosing is going to be really interesting. To Tom's point, though, how much is the backdrop of what's going on with the pressures in the commodity sector, with the pressures on the Chinese economy as a result of what's going on with COVID? How much is that coloring the negotiations, changing the leverage points? I really do think about that because it seems like there has been some shift and there has been a bigger concession on the Chinese side that we had not seen in years.
If this happens, but it has been decades of the US making concessions, believing that the Chinese government would ultimately like to become like the West. And that's not happened. And that's always been a story. And Tom, that's why, in many ways, Europe and Germany carried on engaging with Russia. This idea that somehow Russia And the Russian government would like to become more like the West. And that's not happened. It's failed in a massive way.
Yeah, but I would not, yes and no. You're absolutely right, but I would not provide equal balance there. I would say Germany really has learned that what they did for decades, let's lean on Mr. Schroeder right now, didn't work out. And the change of this first quarter in Germany is historic, truly.
Someone said to me recently, and I forget where the line comes from, Tom, but the longer you wait to deal with a dictator, the higher the price is. And we've waited a long, long time. A long time. Futures up 0.4% on the S&P. From New York City this morning, good morning for our audience worldwide. Payrolls 8:30 Eastern time. The estimate 490K.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
There is a wide range of uncertainty surrounding economic, inflation, and labor market outcomes.
As you have to price in even more Fed hikes, that's going to challenge the growth narrative.
What the yield curve is discounting is higher odds odds of a growth slowdown next year.
As this recovery matures, what we expect is a shift in consumer spending.
There is demand destruction that's occurring, and there is substitution that needs to happen.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Futures up 0.5% on the S&P. Kicking off Q2, Tom, with payrolls just around the corner. 490K, the range anywhere from 0 all the way up to 700,000. That's your range of estimates for payrolls this morning.
We'll talk through the 2 hours on that, and it'll be a lot about wage growth, the wage dynamics. But what Marvin Lowe said there in the opening, John, I think is maybe the Q2 theme wrapped around this jobs report, the jobs report around the May 4th Fed meeting, and on. And that is the mystery of demand destruction, given the way prices are moving up in America.
Inflation sky high, not just in the US, but in Europe too. On April 12th, the next read of CPI, Tom. Then it's on to May 4th, the Federal Reserve, and everybody lining up to call the same thing. A 50 basis point move from this Fed.
Up in my soapbox, John, this is massively nonlinear. I'll let Dr. Alarian and the others talk about it. Bill Dudley, I think, is hugely qualified to talk about this. This 50 beeps point move is not like the third or the fourth or the whatever that Andrew Hollenhurst is talking about.
It's become the consensus call, though, for 50 back-to-back. Lisa, that's the call now on the street. I don't have a single bank right now that doesn't believe that. 50 basis points at the next meeting, 50 basis points after that.
We'll talk with Priya Misra coming up. She believes that as well, how much that does affect the narrative, and frankly, whether risk markets have really priced this in. We were talking before this year about how an increase of this stature at this pace would disrupt capital markets dramatically. Yes, we've seen a sell-off, but really hasn't in a more material way. At what point do we hit a breaking point?
What did you notice in credit, Lisa, just in terms of the price performance and what came to market, the new issues?
There was a little bit of softening on the edges in certain issuers, just that simply didn't want to pay the higher rates. Others actually wanted to capitalize on rates that were headed even higher. But honestly, resilience, that is really the underlying word. Junk bonds were one of the best performing assets, losing the least in the first quarter, giving you a sense of how risky assets are considered havens at a time where it's really based on a rate story, really based on a strong economy.
And helped out by the energy move, no doubt, as well in that particular part of fixed income. Futures up 0.5% on the S&P. On the Nasdaq, we shape up as follows, up 0.5% also. Yields look like this, up 7 basis points on a 10-year to 240.79. Crude at 100, basically unchanged on the day. Euro dollar unchanged too at 110.63. Inflation anything but unchanged. 7.5% CPI, Bramo, in Europe. Unreal.
Yeah, and I keep thinking about, have we priced in not just a move in the United States, but a move globally to higher yields? What does that do to the investment thesis after years, decades of don't fight the central banks? 8:30 a.m., the latest on the U.S. economy. We've been talking about it. 90 minutes. U.S. payrolls report for March. We've been talking about the range of estimates. The median is 490,000. How much does this bring the U.S. unemployment rate down as the participation rate increases? And how much do wages continue to climb? Currently, the expectation is for a 5.5% year-over-year increase in average hourly wages. How much further can that go? And frankly, at what point does that bring even more people into the labor market, which is what a lot of people want to see. At 9:30 a.m., we get U.S. auto sales, which are expecting, and we're going to get them scattered throughout the day, they're expecting to be really low, actually, probably the lowest pace of increase in sales going back a decade. How much does this really get fueled by the fact that people have already bought cars? Everybody was out buying cars. The prices have gone sky high. And frankly, we're having production issues, which leads us to 10 a.m., which is the ISM manufacturing data in the United States, following a number of softening prints out of Europe, because now we're dealing with, okay, maybe COVID's not there, but we're dealing with the shock of what's going on with the Ukrainian war. And even in China, and COVID still very much is there, and you're seeing the biggest plunge there in manufacturing, according to a private gauge overnight, going back to the heart of the pandemic. John, it is a complicated picture of dueling shocks.
Lisa, thank you. And that's why it's so difficult right now to be a central banker. Priya Misra joins us, head of global rate strategy at TD Securities. Priya, let's start with the jobs data, 8:30 Eastern time. What are you and the team looking for?
We're looking for a slightly weaker than consensus number. We're looking for 350,000. Some of the higher frequency indicators that we track is suggesting some slowing in growth momentum. But I will highlight 350 at this point in the cycle is still very strong. So we don't think this actually changes anything for the Fed. We expect them to go 50, another 50, and then continue with 25 basis points to sort of get to that terminal rate.
What does the labor economy do, Priya, and the rate economy do? The entire spectrum of rates do, given nominal GDP of 14%, moving down to something like 5 or 6%. Is there a change or not? Is it just business as usual?
Well, it's business as usual for now because conditions are extremely accommodative. You know, you look at real rates, they're extremely low in the long end, but the Fed is on a mission. They want to get to neutral. They also want to keep inflation credibility and they want to engineer a soft landing. I don't know if they're going to be able to do both of those things. But right now, I think the market's pricing in that they will be able to tighten conditions, slow growth down perfectly. Maybe they've got to cut a few times, in 2024, 25 to sort of engineer that soft landing. But I think growth is absolutely going to slow. That's the point. And financial conditions are going to tighten. That's the point of Fed hikes. It's all about the speed of that move, and is there fundamental strength in the economy that the consumer can handle higher, costs everywhere, plus higher mortgage rates? I think you're going to see, we're going to all have to look at the data, and the Fed's going to be nimble. They're telling us that, which is why I think a straight line up to 3.5%, I really struggle with the market starting to price that in.
Priya, what's your sense of what the Fed would prefer? Trying for orchestrating a soft landing and allowing inflation to potentially become unmoored, or getting inflation under control?
That's the trillion-dollar question, really. It's going to, and I think it's a question really for later this year. I think right now they really want to get to neutral. They want to start the balance sheet runoff as well. When they get to neutral, I think that's when your question is something we'll all be focused on. Our view is if some of the broad-based inflation metrics start to decelerate, if we start to see labor force participation continue to rise, I think then the Fed is going to look at the forecast of inflation that's going to be weaker. And at that point, can they tolerate 2.5%, 2.7% PCE in order to allow growth to slow down? I think they would. So they try and engineer that soft landing, even if it means a little bit longer to get to that 2%. If we're not seeing any of the fundamentals change on inflation, I think then they'll have no choice but to really take us into a hard landing scenario. But I think it's too early to make that call right now.
And Priya, neutral is this concept that we talk about on programs like this with conviction. And people outside of fixed income and outside of Wall Street sit there and say, oh, neutral, that sounds important. There must be a lot of work that goes into that. I'm sure it's scientific. Priya, how do we come up with what neutral is? How do we know where it is?
So there's a lot of academic work on neutral. Lobach Williams, I think, is the one I give the most credibility to. Wide standard error there. But I would say there's also, neutral for the balance sheet. So, we would argue, I think the Fed is around 2.5% for the funds rate. But when you're also letting the balance sheet run off, I would actually take the lower end of that and say it's closer to 2%. I mean, we'll actually find out as we get to neutral, if it's slowing growth, if there's demand destruction. I think we realize what neutral is. In the last cycle, I would argue they overdid it. 2.5% on the funds rate was too high if you're also going through QT. We're going to be in the same situation here. So I would argue somewhere in that 2.5% range is neutral. The key question is how much higher is the Fed going to go? And that's what the yield curve is pricing in. If they go a little bit higher, they'll have to cut, because I don't think there's any evidence that neutral is higher today, post the pandemic.
Priya, we're about 90 minutes away, a little bit less, from this payrolls report. Does it matter?
I would say the headline number really doesn't matter. I would look at participation, wages. These are all questions for your ultimate question is the Fed going to be able to engineer a soft landing? If we're seeing no signs of participation rising, if wage inflation remains high, I think the fear around this wage price spiral will mean that they're going to have to hike much above neutral than even what's priced in. So I don't think it matters as much for me. It matters for what's that terminal rate, how much higher than neutral do they have to go.
Priya, thank you. As always, just wonderful. One of the best on Wall Street. Priya Misra there of TD Securities. Tom, I've quickly got hold of that Goldman note from Jeff Curry on this energy move from the administration. And the first page concludes like this. The US policy use of an SPR release a potential deal with Iran, extreme price volatility and the growing risk of a recession next year are all exacerbating the uncertainty faced by producers, reducing their incentive to invest more. That's the conclusion of Goldman and Jeff Curry. Tom, of course, the administration takes a different view on what oil majors should be doing.
That is the heated agreement of Paul Sankey, who was heated with Curry there, that we're just simply not going to see the investment click in as before. John, I was thunderstruck by Priya Misra there and the distance between her and Andrew Hollenhorst. And it's not a terminal value, that's really not the right phrase, but just where is the comfort of higher rates? And Misra's set is much lower than what we're hearing from Citigroup.
Well, the divide, I think, is driven by the following. Financial conditions are still pretty easy. They're not that restrictive, are they? That's probably a better way of putting it. And in some weeks, over the last few months, they've become less restrictive, even as the Federal Reserve has ramped up its plans to tighten interest rates. And Citi's idea is that if you really want to get inflation down, you have to get restrictive. You have to constrain demand. And to do that, you're going to have to move not in 25 basis points increments, but 50 basis point increments, and not at one meeting, Lisa, over a series of meetings.
One of the biggest wild cards to me is how the Fed treats profit margins continuing to expand. This idea that if companies do well, which is a lot of what people who are risk on feel, that could be a negative for them. And so at this point, are they looking for the stock market to decline in order to actually take their pedal off the gas, or are they going to keep going until that happens?
So the reason I set up an energy conversation initially anyway was so I could tease our guest a little bit later. Amos Hochstein, the Senior Advisor for Energy Security at the US Department of State. It didn't work out. We went back to fixed income, but that's fine. Futures up 0.5% on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Bloomberg's learned that the UK has agreed to join the U.S. in releasing oil from its strategic reserve. No word yet on how big that release will be. President Biden announced the U.S. will release 1 million barrels of oil a day for 6 months. The goal is to lower gasoline prices and reduce dependence on foreign oil. Ukraine says direct talks with Russia are set to resume today. These negotiations will be by video link instead of face-to-face. Meanwhile, Russia says that Ukraine forces made a rare strike across the border. 2 helicopters hit a Russian oil tank facility. Economists surveyed by Bloomberg expect another strong U.S. jobs report today. The median estimate is that employers added 490,000 jobs in March. The unemployment rate's expected to fall 0.1% to 3.7%. The jobs report out at 8:30 New York time. Eurozone inflation has accelerated to another all-time high. In March, consumer prices rose 7.5% from a year ago, well above the median estimate in a Bloomberg survey. Russia's invasion of Ukraine drove already rising energy prices even higher. It also caused more problems for global supply chains. And shares of GameStop soared in pre-market trading. The video game retailer announced plans for a stock split. It wants to increase the number of Class A shares from 300 million to 1 billion. GameStop has become the poster child for so-called meme stocks. Retail investors boosted the stock by more than 700% in 2021. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
The jobs report last month beat estimates.
We have a very tight labor market. It is pretty clear.
Historic recovery in our labor market.
One of the best labor markets in a generation.
Today, Tom, John, Lisa, and Mike will bring you the data and analysis as the numbers cross the Bloomberg.
More people are coming into the labor force. It's going to decelerate the wage gains. Is that good?
As the Fed looks to contain inflation, it's really important that the jobs recovery continues.
The March jobs report, today on Bloomberg Television and Radio.
The geopolitical situation, the energy situation is very severe. I think in the United States, we are insulated a notch. When I think about kind of the global situation, coupled with the Federal Reserve potentially hiking very rapidly, maybe 1 in 4 over the next 18 months, it is significant.
Nathan Sheets there, the Citi Global Chief Economist on the Outlook. Futures this morning, good morning, up 0.4% on the S&P and the Nasdaq 100, up 0.5%. Going into payrolls, 1 hour and 12 minutes away. Your estimate, 490K. Over in Ukraine, Tom, the war continues and the talks do as well between Ukraine and Russia.
We're going to continue our discussion on this in this busy jobs day and, of course, with the advent of the second quarter. There is percolating in the zeitgeist something really interesting. And I want to make clear it is unconfirmed, but the Financial Times summarizes the unconfirmed reports of 2 helicopters of Ukraine, unconfirmed, moving 50 miles north over Russian territory to take out a fuel depot. We got to be careful with this, folks, because this is really stewing right now without Russian or Ukrainian confirmation. Maria Tadeo in Budapest, Emily Wilkins in Washington. Maria, what is the significance, if this is true, of a Ukrainian movement into Russian territory?
Yeah, and Tom, you're very right. We have to be very careful. But what we know here is that, according to Russia, 2 military helicopters hit a depot in the city of Belgorod. That's in the border between Ukraine and Russia, and it would mark the first escalation from Ukraine into Russian territory. So the Russians say President Vladimir Putin has been briefed on this, or looking at all of the information, but they also signal and hint the timing of this is not ideal because there was supposed to be a new round of talks today, and this is going to impair that. When you talk to the Ukrainians, however, they say that they don't have the full picture. We don't have confirmation or a denial from them. And they also say be very, very careful about what Russia says is an attack, because a lot of this could be a false flag.
But Maria, to that point, a lot of people believe that what we've heard out of the Kremlin, frankly, has been a way for Russia to regroup and then go more hard-hitting into the Donbass region. Is that basically what a lot of the allies are viewing this as, is perhaps a way for Russia to re-escalate or back away from some of the talks?
Yes, and you know, there's two very important points to make here. One is that, of course, Ukrainian officials have said for a very long time that their main concern now is that unable to take the capital of Kyiv, and we should really stress that. The Russian forces weren't able to take the capital. It was fortified. It was locked and sealed by Ukrainian officials. Unable to do that, unable to make ways in the west, they would now move to the east and essentially separate the country. It would be East Ukraine, West Ukraine, and once you've captured half the country, then you sit down for the real talks. That is what Ukrainians worry about. When you talk to European officials, they say exactly the same thing the United States have said over the past 48 hours. They don't see anything on the ground that would point to a de-escalation on the military operations, just moving troops from one place to another. And again, the big concern here is that you could see this country split in two.
Emily, from the Washington, D.C. side, we heard from President Biden yesterday about supporting gas prices in the United States. We talked about that oil reserve release. How much is there a focus on increasing gas supplies to Europe? Have we heard anything comprehensive out of the White House about what they're doing on that front?
I mean, certainly part of this release, yes, it is to bring down gas prices in the U.S., but it is also to help the allies overseas in Europe. I mean, remember, the U.S. only got about 10% of its gas from Russia, obviously much, much higher for many of the European allies. And the Biden administration has committed to that. They have committed to helping out. But the thing is that even with the 180 million barrels that the U.S. is releasing, that's not really enough to cover the worldwide supply that could be lost from Russian oil. And you are seeing other countries begin to step up, tap into their reserves. You heard the UK announce 30 million barrels this morning. But this is just, it's going to be a huge impact. And from the messaging that we are hearing from the Biden administration, he even said yesterday, he talked about patriotism. He's really sort of tied these, he has. I mean, this is the messaging coming from the White House. Granted, a lot of Americans aren't buying that, but it is the message that Biden and Democrats are really pushing.
Emily, we're going to talk to Amos Hochstein here at the top of the 8 o'clock hour on the way to the jobs report. Let's get out front with somebody more abrupt like Emily Wilkins. Ruder and abrupt. Emily, if the Germans and the Russians screw this up, what do we do? Send an armada of boats across the Atlantic? Forget about the happy talk patriot stuff. What do we actually do to assist our allies?
I mean, Tom, there's really no appetite right now in Washington to take American troops and bring them over to Ukraine and to get them involved in this at all. I mean, yeah, you saw those troop deployments to Poland and to other areas in Eastern Europe. But when you talk to lawmakers about this, they're just not there yet. They're still on the point of sanctioning Putin, sanctioning Russia, and going ahead and providing aid to Ukraine. Now, lawmakers have said that there could potentially be a red line, maybe if nukes were used, if nuclear warheads, if there were certain maybe large-scale atrocities going on. But at this point, those discussions really aren't happening in D.C.
Emily, thank you. Tom, you know how this works, and it's very frustrating. This is about politics and not making good policy. And it often is, and this is the case right now. You find something to blame, a piñata, in this case it's domestic oil producers, and you go after them. But you don't make good policy. Trafigura said this to Guy Johnson yesterday, just reading through the notes, going over some of the lines from this. We risk disincentivizing US producers to ramp up sustainable production to replace Russian barrels and at the same time encourage consumers to use just as much gasoline. The opposite needs to happen. The last line, Tom, is so important, and no one in the administration wants to come out and say it. People need to use less energy.
Well, yeah, we haven't got there yet. John, to be blunt, that'll happen with price. It's always about price.
But it's not, Tom.
John,
no. They've come out with a plan, Tom, 10 points on how to use less energy. Bottom line is, no one wants to be the person to come out and say, dial the thermostat down, put on a sweater. You know what happens, Tom? It's terrible politics, precisely.
John,
that's why they don't want to do it. So instead, we go after an oil producer, Tom, and blame them.
We live this. My sisters could see their breath during the first oil crisis. My father turned the heat down so low in the house. We could play hockey in the living room. It got that cold.
How did that work out politically?
Politically, it was great. There was no Brandy Melville for them to shop at the time. John, look, my question to Emily and my question to Amos Hochstein is going to be the same. In World War II, we did a convoy to Europe to help them with supplies and that. Is anything like that feasible if the Germans face what they're going to face in April of this year?
If indeed they actually have to face restricted supply coming out of Russia, Tom, it's going to be tricky. But that's a different story altogether, isn't it? What happens with the European gas and their access to energy. Domestically, we've got a big conversation coming up in about 35 minutes' time. Futures up 0.5% on the S&P. Yields up 6 or 7 basis points to 240 on 10s. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
big conversation coming up with the White House in about 30 minutes' time, a conversation about energy. Looking forward to that one. Futures up 0.4% on the S&P, on the Nasdaq, up around about 0.5%. A quarterly loss behind us, the first quarterly loss on the S&P going back 2 years. It's been that long. In the bond market, 2s, 10s and 30s, your yield higher, much higher. Last month up by 90 basis points on a 2-year alone. Right now 238.54, and the difference between 2s and 10s just 2 basis points. That difference has got narrower, smaller. That curve has got flatter, Bramo. And many people, as you expect, once you get down to these levels, they start pushing back about the relevance of that and what it means for the future of this economy.
Yeah, people are looking at the Federal Reserve saying basically this is irrelevant, and then saying that's the best indicator that you can have is the Fed saying don't look at this and that this time is different. And you know what happens then. I do think, though, going back to Priya-Misra, how much is this signal choosing between a soft landing and reining in inflation for the Fed?
Is it a binary choice between a recession and a slow story around inflation, Lisa? Is it about that, a hard landing or a soft landing? Is it a binary choice?
Increasingly, yes. Honestly, that's what a lot of people are saying. Mohamed El-Erian, I thought, was fascinating when he was speaking earlier today in the morning in Europe, basically talking about how he would actually go on the err on the side of not going quickly enough because of that fear of recession.
That was Mohammed a little bit earlier. Here's the story in foreign exchange. Euro-dollar shaping up as follows. Your euro looks like this, 110.54, negative about 0.1%. CPI in Europe, a problem for the ECB, 7.5% on CPI. We were looking for something with 6. We had something with 5 previously. It came in at 7. The alarm bell might be ringing over at the European Central Bank. 110.54 on euro-dollar. Let's get you some price action, some single names, and say good morning to Romain. Good morning, Romain.
Hey, good morning, John. Some of the most active stocks here in the U.S. are, well, stocks based in China. A Bloomberg report saying the Chinese authorities are working on a framework to actually resolve one of the big regulatory disputes out there between the U.S. and China. This is about giving U.S. regulators full access to the auditing reports of the 200-plus Chinese companies that are listed here in New York. Remember, the NASDAQ Golden Dragon Index has actually booked 4 straight quarterly losses, down about 65% from that all-time high, and a lot of that has to do with the regulatory overhang. The 2 biggest weightings in that higher here in the pre-market, Alibaba up about 7%, NEO ADRs up about 6% here on the day. Aditi, it was actually one of the big outperformers here. Those ADRs moving higher by about 15%. We should point out this is based on Bloomberg reporting, citing people familiar with the matter, but we've heard a lot from the SEC chairman, Gary Gensler, here about the potential for progress on this issue. All elsewhere here, back in the U.S., we're actually seeing a little bit of a bid come back into some of the meme stocks. Some of this seems to be predicated on the announcement from GameStop yesterday that they were going to pursue a stock split. Remember, this wasn't an actual proxy statement. This was a press release saying that they plan to do something and they plan to ask for authorization at an annual meeting that still hasn't been scheduled. GameStop shares nevertheless up 16%. AMC moving higher as well, up about 4.5%. And one of the other meme stocks, BlackBerry, which had been in favor for quite some time, moving lower here, down about 4%, Tom, after reporting earnings. Remember, this is a company that doesn't make phones anymore, primarily software.
What do they do?
It's security software for mobile devices. That's basically about 98% of their business right now, and unfortunately, that business looks like it might be slowing.
I got a BlackBerry that Bill uses as a chew toy. Yeah, he uses it as a chew toy. It's good. Romain, thank you so much for that. Look for the close this afternoon to begin the second quarter of this year. On this jobs day, it is always instructive to speak with macro policy perspectives. Julia Coronado. In other times of tumult, she was absolutely definitive in nailing a slowdown in economic growth. Dr. Coronado, thank you so much for joining us today. What will our next slowdown in economic growth look like?
Well, look, we've got one in train right now. We're seeing GDP tracking slower in Q1, and that was sort of the intention of a lot of the removal of policy, was to slow down the economy and cool it off. And so we're already seeing some evidence that that's taking hold. I mean, of course, the consumer's very healthy, strong job market, good balance sheets. It's not necessarily a worrisome slowdown, but the consumer's getting a lot thrown at them right now with higher gas prices, the removal of fiscal support, higher mortgage rates, So we are sort of undeniably going to see a slowdown of some magnitude. The question is how fast we slow down.
Let's go all John Williams on you here, or maybe more David Blanchflower of Dartmouth here. If the unemployment rate trends down in a fully employed America, and dare I say 2.x% out there somewhere in terms of an unemployment rate, the other side of that is the rate restructure. Can you say that the great moderation is over?
I don't think we know that, Tom. I mean, look, we have been hit with one of the biggest shocks we've ever seen in our lifetime, not just in terms of the pandemic and all that came with it, but the structure of the economy has been shocked. The shift into good spending is the biggest we've seen since World War II. So this is just an enormous shock to the structure of the economy. We're still reeling. We're still dealing with the pandemic in terms of the global supply chains in China. So it's very hard to say that what the dynamics look like on the other side, because it's been shock after shock after shock, and the economy is reacting and adapting, but it doesn't happen overnight. So in terms of just what does the labor market look like on the other side of these shocks? Do we ever get to the other side of these shocks? And what do those wage inflation dynamics look like? Obviously, the Fed is concerned enough that they don't want things to become more deeply entrenched than they already are. All we talk about it is inflation. I think they're worried about that getting inside the heads of consumers and businesses, and they want to, they're willing to take some risks here of a bumpier, I think Chair Powell called it soft-ish landing, right? You've got to ensure that slowdown is underway. And those inflationary pressures don't broaden and deepen even further.
What would you have to see, Julia, in this labor report that we're about to get that would give you a sense that the Fed will be increasingly concerned about inflation expectations becoming unmoored and err on the side of going faster?
Ever faster? We keep ratcheting faster and faster. I'll tell you one thing I saw in the last report, Lisa, was actually some good signs. We have now a very well-established recovery in labor force participation. We talked about it last year. The Fed worried about it not appearing in the fall. It's here. It's definitely here. You look at prime age labor force participation, the recovery is strong enough to lift overall labor force participation. And so, that seemed to provide some relief on wages. We saw slower gains in wages. So we'll look to see whether that continues. If, on the other hand, it doesn't, I don't know that the Fed needs to ratchet ever faster. They've already signaled that they're going to go at a much faster pace this time and start the cycle with maybe a couple of 50 basis point rate hikes. So, I think if we get strong wage growth and no gain in labor force participation, that's a more inflationary report, and vice versa. If we get further rebounds in participation, we've seen, for example, wage growth in leisure and hospitality, which was the red hot wage growth last year. That has moderated over the last 2 months. It's been flat to down. So it looks more like a level shift for that sector. And then we could see more normal wage dynamics going forward. So those are kind of the tea leaves we're going to be looking at in terms of, I think wage growth is more important ever as a part of the employment report, certainly for markets, in terms of reading those inflationary tea leaves. Are we seeing ever higher, broader wage inflation, or are we seeing it more of a rotation in wage inflation from the sectors that were hot last year to a broader base but more moderate this year?
Just quickly here, Julia, do you think that the Fed has to either cause a recession or else allow inflation to be materially higher for a longer term than they have been comfortable with in the past?
I mean, I think there's a whole range of possibilities in between. Certainly recession risks are higher, combining everything we're seeing globally. And does the Fed need to cause a recession? Certainly that's not the intention, but they are, slowing the economy down, actively moving to slow the economy down. And so, of course, the risks in that direction are higher. Whether we need that to cool inflation, I think there's a lot of framing of this discussion as if it is all a Phillips curve dynamic. And it is still the case that it is not primarily or dominantly a Phillips curve dynamic. There is a lot of supply chain issues that are complicating things. You can see that because regardless of different labor market experiences and different fiscal levels of fiscal support, we're seeing inflation, goods inflation rise around the world. And so if we can cool demand, it's not going to be a linear thing. These macro models don't neatly capture these inflation dynamics. Once goods inflation moderates to the point, once goods demand moderates to the point where supply chain pressure eases, it's going to ease. You know, you're going to start seeing price competition in consumer goods markets again. And so, you know, I think there's a whole range of possibilities where we could see inflation cool with, you know, if the housing market cools substantially, that's going to be an important source of moderation in inflation over time. So, you know, I think we could see certainly some bumps on the road, whether that turns into an outright recession. I mean, again, you look at this economy, this labor market, these consumer balance sheets, and it looks like we've got a really good base for resilience.
That's the Chairman Powell view. A more nuanced one there from Julia Coronado of Macro Policy Perspectives. Julia, thank you, as always. There is a more binary view, and we touched on it moments ago, and let's clarify that conversation. Mohamed El Erian was on with Francine Lacroix earlier this morning, and Mohamed's view is essentially, Lisa, if you want to get inflation down, the price you'll have to pay is a recession, or you can tolerate higher inflation. It's one or the other. It's that binary for him. I just wonder if that is the case.
I can't answer the question because obviously I don't have a crystal ball. What Priya Misra was saying was kind of echoing that and saying that the curve inversion or the flirtation with curve inversion seems to be suggesting the same thing. So there is a feeling that perhaps Mohamed, as he often is, was right.
Futures up 0.5% on the S&P. Payrolls 8:30 Eastern Time, 50 minutes away. Your median estimate 490K. From New York, heard on radio, seen on TV. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden says Russian leader Vladimir Putin may have fired some of his advisors or put them under house arrest. He also said it's an open question whether Putin is fully informed on how his military is doing in Ukraine. The Kremlin says those remarks were a perfect example of disinformation. European Union leaders have a warning for China's President Xi Jinping. China will hurt its global stature if it helps Russia during the war in Ukraine. Now, that message will be delivered in a virtual summit today. The warning will test Beijing's commitment to keep the war from damaging its ties with the EU. Shanghai has started part 2 of its own phased lockdown. It's confining some 16 million people living in the western part of the city to their homes. A 4-day lockdown of eastern Shanghai just ended. During the lockdown, residents are barred from leaving their homes unless they're going out for mandatory COVID tests. The House has moved forward a key piece of President Biden's drug pricing agenda. Lawmakers voted to limit what insured Americans pay for insulin to $35 a month. Now it's up to the Senate, where a bipartisan group is coming up with its own insulin proposal. It's called the pizza principle, and it's one of the mainstays of New York economics. It states that the price of a slice of pizza will always be the same as a subway ride, and it's held true for decades. Not anymore. The price of a plain slice is soaring above $3 throughout the city thanks to higher commodity and labor costs. In Manhattan, the average is $3.26. Meanwhile, subway fares have been frozen at $2.75. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts, great questions.
I really believe we're underestimating the medium-term impact of this war. We will have consequences, longer-lasting consequences on energy security, food security, I think digital security, payment system security, trade.
And that's the big worry here. That was Dr. Lawrence Boone there, the OECD chief economist, that we haven't fully realised the aftershocks of all of this through the next year and maybe beyond. Futures this morning, and good morning to you, up 0.4% on the S&P 500. In about 42 minutes' time, we get a payrolls report in the United States of America. Tom, the estimate, 490K ahead of that yields higher, just short of 240 on a 10-year yield.
We're going to dive into that. Randall Crosner to join us, the former governor of the Federal Reserve System. And then, of course, Jeff Rosenberg will give us the after 8:30 look, an important report. And we're really going to focus on some of the inflation teases that we may get out of those two reports. We digress at this moment, and we do so with my book of the summer, a couple summers ago, 2034, a novel of the next world. When Elliot Ackerman wrote this with James Trevitas, they had no idea the overlay of their book of the South China Sea and how it would turn to Ukraine. The former Marine joins us this morning. Elliot Ackerman, you have legit military duty. Your work in Afghanistan, your work with CIA at the end of the tour. The Atlantic article of you speaking to a modern Marine was stunning about the reality on the ground in Kyiv and in Ukraine. What was the distinction of your conversation with the Marine in your Atlantic essay?
Well, as you might know, that there's been a large number of foreign fighters, Americans, Brits, individuals from Balkan states who've come to Ukraine to fight. And so I had a conversation with a former Marine who served in some of the similar infantry units I had served in, and he had been fighting in the trenches around Kyiv for the first about a month of the war. And, the most salient point he was making to me was that the anti-tank weapons that we've deployed to Ukraine were making a huge difference in that fight and allowing 2 or 3 well-armed Ukrainians to stop entire Russian armored columns. So, that was one of the most salient points he made, as well as really just the intensity of the fighting that he had witnessed, which he said exceeded anything that he had participated in Afghanistan.
Take us beyond the media reports of brave journalists in Ukraine, those covering it day by day. How do the Russians adapt to a difficult march?
Well, it's yet to be seen whether or not they're going to be able to adapt. Listen, the Russian way of warfare is different than the American or Western way of warfare. And one of the most critical ways that difference manifests is, the Russians have a very difficult time adapting because they have extremely centralized decision-making structures. So, all the decisions are made by a group of colonels or generals, and those decisions are disseminated down to subordinates who aren't supposed to ask questions or show individual initiative. In Western militaries, we fight with something we call mission tactics, which means even the lowest, 21-year-old corporal understands the mission and the intent behind the mission, because the expectation is always that the plan's not going to work, that the enemy has a say, and that everyone's going to have to adapt. So our Western militaries are very adaptable. And the Ukrainians, since 2014, have undergone a series of reforms to make them more like a Western military. So we're really seeing the contest between a Western military style of fighting and a classic Soviet or Russian style of fighting in Ukraine, and the result has been a lack of Russian adaptability.
There's been a lot of times where the West has perhaps miscast other nations that follow a different set of rules in a way that tries to reflect their own. Are we overstating or understating the hit to morale that so many people talk about among Russian troops?
I think that we are underestimating it, and I think we've continually underestimated not only the hit to morale for the Russians, but we've been habitually overestimating Russian capability and underestimating Ukrainian capability, as though we, for some reason, seem unwilling to conceive of the idea that the Ukrainians could win this war, and in fact are winning this war right now. It's important to note there's historical precedent for this. During the Second World War, Russia, which defeated Germany in the Second World War, invaded Finland, a small nation, but very nationalistic, and the Finns defeated the Soviets. So there's precedent for this. The Ukrainians are winning. I think having spent time there, that we should back a winner. Usually that's a pretty good strategy, and continue to support the Ukrainians in this fight they're taking to Russia.
Elliot Ackerman, we've taken great pride in our interviews with the military in this war. You may be aware there's another division of the U.S. military called the Army, and we met with their General Kimmett, of course, with his substantial infantry experience in Germany and in the Persian Gulf. And General Kimmett was heated that the Russians were unprepared for the urban battles to come in the war. Is that what we've observed this month? And what do those new urban battles look like for the Russians?
No, well, we're seeing the Russians, make some gains in a few select Ukrainian cities, but they've had to completely destroy those cities to win, in places like Mariupol. But the much larger story is in places like Kyiv, cities that are real centers of gravity politically. And the Russians haven't even gotten to Kyiv. They've been stopped in the suburbs. Kyiv is a city before the war of 4 million people. The Russians just simply do not have what we call the troops to task, meaning the troops they would need to accomplish the mission to take a city like Kyiv, let alone to take the entire country. Ukraine is a nation of over 40 million people. The Russians have an invasion force of 200,000, and it's a nation that has been completely mobilized, unlike anything I've ever seen in my lifetime. This is the fourth war I've been around. How much people are mobilized, from 20-year-olds up to kids who are helping do work like knit camouflage nets to grandmothers. It's going to be very, very difficult for the Russians to achieve anything more than potentially some limited territorial gains. And even at that, I don't know if the Ukrainians would allow President Zelensky to give any territory because, and rightly so, they perceive themselves to be winning. So their view is, why should we be ceding anything? We're winning this war.
And that complicates the talks all over again. Elliot, a clinic, an education, always learn something. Elliot Ackerman there, the author and former U.S. Marine. Tom Complex. Tom, you follow the map more than anyone I know. Where's your focus shifting to now?
My focus is still in the Black Sea. I'm sorry, but it is about water. It is about Navy. That is the ancient Peter the Great Russian heritage. They need a path to the Black Sea, and they're going to move down. Are they going to move to Odessa? I don't know. Are they going to go beyond Crimea to Odessa? I don't know. But what I think this week, John, there's been a dearth of information about how Ukraine responds to the Black Sea advance of the Russians.
Tom, just quickly, from your perspective, how important is it in that respect, in that regard, that Turkey is the mediator in some respect in these talks at the moment?
Well, I think it has to do with the Bosphorus Strait, and, you know, Turkey's in a very, very sensitive position here. What I would focus on more than Turkey, John, is Stoltenberg's comments at NATO and on Romania and what is going to be the build-out of the Western world on the shores of the Black Sea in Romania. To me, that's the great mystery 1, 2, 5 years out.
Tom Keane, Lisa Bravitz and Jonathan Ferro counting you down to payrolls. That report, 35 minutes away. Going into it, up 0.4% on the S&P. Yields higher by 5 or 6 basis points at 239.32 on a 10-year, and crude lower by 1.8%. The White House on oil next.
Nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor, y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes, como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In the equity market, there is more optimism around, the Fed being able to rein in inflation.
They want to see a deceleration in inflation, not so much a deceleration in demand.
The consumer is extremely sensitive, and there doesn't seem to be any relief around the corner.
There is a belief that toward the end of the year, supply markets will balance.
We are seeing evidence that tail risk is reducing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. It is Jobs Day. The usual great guests will join us. Jeff Rosenberg to join here in a bit. Randall Krosner, the former governor of the Fed. And John, guess what? It's not a normal Jobs Day. We have 5, 6, 7% inflation.
In Europe and in the United States as well, Tom. As for the payrolls report, put a blindfold on and throw a dart because the range is super wide. Once again, from 0 all the way up to 700K. The median, 490,000. The number drops in 30 minutes.
Within your reading, John, can we say this Jobs Day could adapt or adjust Fed policy? I'm not there.
I think, Tom, for the 50 basis point move in early May, this is a jobs report that needs to tell the Fed not to, rather than tell them why they should. I think they're already there. 50 basis points, the whole of Wall Street getting behind that view.
We'll speak to the White House here in moments. And I just say, Lisa, that the political backdrop of this jobs report is seen in a gallon of gas, but really now percolating into all the inflation of America. It's a different labor economy.
Yeah, the conversation this morning is about the very hot labor market, all this good news that we're hearing out of the economic data, and then the sentiment of consumers, which is low and lower, and it's because of gas prices. It's because of the inflation. How do you respond to that at a time where it still isn't materially crimping consumer demand enough to be a self-fulfilling cycle?
In the first quarter, Apple Computer 178, and at the end of the quarter 178. I guess it was a boring quarter, John. Let's do the data now to get to our esteemed guest, but it's simple, John. What an odd quarter for equities.
And ending with a massive month of gains as well for some of those names, Tom, including Apple. Equity futures up 0.4 on the S&P, on the Nasdaq 100 up 0.5%. Yields higher by 6 basis points. What's the spread now, Tom, between 2s and 10s?
2 beeps.
2 basis points. 30 minutes away from your payroll report. Crude lower, Tom, 98.82 on WTI. We're down by 1.48%.
Ira Jersey to join us later with Gina Martin Adams. And again, Randall Krosner will join us here with perspective on the greater economy and this labor economy. But first, we need to look at that $6 gallon of gas in Mammoth Mountain, California. And yeah, it's cheaper other places, but it is front and center for President Biden. Joining us, a gentleman hugely qualified on this strange word, energy security. Amos Hochstein is Senior Advisor of Energy Security at the Department of State and joins us today. The thing here, Amos, every time around is whip inflation now. And every president has a different path, like Jerry Ford, to whip inflation now. And your reading of history is the same as mine. This is a tough task. What is the first order of business for Joe Biden?
Well, I think, first of all, good morning, and thank you for having me on the show. As you said before, energy security is a critical issue. And I think the president took strong steps yesterday to address the fallout in the energy markets as a result, a direct result of the Ukraine war and the invasion, the unjust invasion and brutal war that Putin is waging in Ukraine. And that has consequences, as the president said yesterday, here at home with rising costs of energy, rising costs of oil, which of course translates, as you said, into rising costs of gasoline for Americans. So President Biden took a strong step yesterday, announcing the largest SPR release, the Strategic Petroleum Reserves, 1 million barrels a day for the next 6 months. And that we've already seen prices come down as a result of that announcement. That's going to have a major impact in the oil markets and the energy markets writ large.
Yeah, okay. But Amos, what's important here, and this is pizza security, John, this filters down into every product, including a slice of pizza at Famiglia in New York. It is up, up, up.
You're very delicate about the slice of pizza in New York, Tom.
I think it's as important as a gallon of gas.
I agree it's important. There's another measure, Amos, that you announced yesterday. You called on Congress to do something, to make companies pay fees on wells from their leases that they haven't used in years, and on acres of public lands that they are hoarding without producing. That's from the statement from the White House released yesterday. The administration keeps talking about these 9,000 leases. Amos, I don't think if you wrote this, you would have written that. Because if I asked you the following question, I want a direct answer to a direct question. Of those 9,000 leases, how many of those sit on productive land?
So I will answer you a direct answer, but let me just say on slice of pizza price, I agree. The prices are going up everywhere. Part of that is as a result of these skyrocketing energy prices, where we're not a farm to table economy, we're a farm to truck to table. So everything that we consume has to go on, has resulted in a gallon of gasoline or a gallon of diesel, trucks coming, crisscrossing the country for delivering, whether it's ingredients for pizza or if it's for other commodities. So there's a direct result, and that's why it's not just the gallon of gasoline is not a political issue. This is a real economic issue that we need to address, and that is a result of a foreign war that we have to be cognizant of. As far as the leases, look, these are on public lands, and your point is right. If some of these leases are on non-productive acreage, then the companies that are holding these leases for several years sometimes and are not doing any seismic, not doing the kind of work that needs to be done on that acreage because they think it's non-productive, then you have two choices. Either you can return the lease or give it up, or you can simply pay the higher fees because you want to hold on to that lease for a little longer so that you can develop it later. And I think that is, I would have written that.
But Amos, do you know why they might want to sit on it and develop it later? It could be on third-rate land that requires a higher crude price. You know how this works. The way this is being framed by the administration is that these land leases are being hoarded, that we're sitting on productive land and it's not being produced because these companies are greedy. I mean, I'll read the line out from the president. His words. Companies have an obligation that goes beyond just the shareholders to their customers, their communities, and their country. No American company should take advantage of a pandemic or Putin to enrich themselves at the expense of American families. What evidence is there that they're hoarding those leases? Wait, I'll finish, then you can go and I'll give you all the time you need. What evidence is there that they're hoarding those leases because they're being greedy to profit from what's happening in Ukraine?
So let's disaggregate. There are a number of issues here. And the president actually recognized the companies, the oil companies, that are responding to this price environment, that are responding to this world supply shortage that we're in, and have announced extraordinary increases in CapEx and in reinvestment in the United States in bringing on additional production. And he's recognized them and said that is progress, and he praised them for doing that. But there are other companies, and you know that, Jonathan, that are saying, look, I have the ability to increase production with prices when prices were at 120 and 130 just a week ago, and said, I'm not going to do it. And he called out some of those who've said, even at $200 or $300 a barrel, I'm not going to increase production because a variety of reasons. And some of them are saying, the funds that back me or that own are my shareholders or my holders of my debt are saying, don't do that. Give us increased dividends during this time. There is no well that is not profitable at 120, at 130. And if you're making a decision at prolonged period of time of above $85, which we've now been in for a few months, that you can't make more investment to bring on production, then I think the president is 100% right to call them out, especially when other companies are saying, no, this is exactly the kind of environment that we are going to increase production. And look, we did two things. One, the president announced that we're going to release 1 million barrels a day in order to increase the certainty of liquidity in the energy markets and to make sure there's enough oil on the market to support the U.S. economy as well as the global economy. Number two, he has said that we're going to replenish the reserve at a time when we finish dispersing and releasing the oil, and when prices come down. So we're going to sell the oil now at high prices, buy it back later. That gives incentive to the oil companies to say, look, I know that even though the U.S. is going to release these reserves, I'm going to have a buyer in the U.S. government later on. So it continues that incentive to increase production. And I think that this is what we needed. We needed to put something into the system where we can bridge. The oil companies have said, if you look at Exxon and Chevron, Conoco, Oxy, have said they're going to increase production. We're going to increase 900,000 to 1 million barrels a day this year. And that means, but it's only going to come on in the middle of the third quarter to the end of the year. So we have a gap between now and that period of time. So what the president did yesterday, this historic move, is to say, the U.S. government's going to fill that gap between now and then.
Yeah.
And put that same 1 million barrels a day of production that we were hoping to get that we're going to get at the end of the year, and put that out now, so that we're not replacing the private sector, we're incentivizing it and letting the American consumer benefit from lower prices between now and then.
The likes of Goldman Sachs disagree. Jeff Curry says this: the US policy use of an SPR release, a potential deal with Iran, extreme price volatility, and the growing risk of a recession next year are all exacerbating the uncertainty faced by producers, reducing their incentive to invest more. Amos, the reason I bring this stuff up is that I want to avoid this really kind of simplistic conversation that something untoward is happening in the oil patch, when you know that what happens in the oil industry is incredibly complex. Now, you've said something else over the last few years as well, over the last 12 months. I'll bring up another thing. This was November 17th. President Biden urged the FTC Commission chair to investigate oil and gas companies' retail prices, blaming industry leaders as gas prices continue to soar. It's become this talking point that oil majors are hoarding these leases, even though you admit we don't know what's on that acreage. We don't know what's on that acreage. Then there's this other talking point that somehow these companies are price gouging, and in the president's words, taking advantage of a pandemic or Putin to enrich themselves at the expense of American families. I'm just asking, what evidence is there of that? You wanted to start this probe. What have you found? What evidence is there? What companies are price gouging right now? And if you can identify them and name them, what are you doing about it?
Well, first, I think, as we said yesterday, I don't believe, first of all, to Mr. Curry's comments, I and my colleagues in the U.S. government, we've been in close contact with the energy industry. And most companies have actually said that they believe what we did yesterday was exactly the right thing to do, and that they feel that it has an incentive because it is for 6 months before their production comes online. And because we're going to spend the next couple of years replenishing the reserve, that means that they are incentivized to continue to spend the CapEx that they've announced to increase production. So with respect to Goldman Sachs, and I take a lot of issue with some of the other things that he said in that report.
Well, I've no doubt you do. But another question you'd be asked as well, Amos, is who would make a decision like this to boost capex on front month Brent futures? Who would do that? WTI futures front month. Who would do that? You know what the rest of the curve looks like. Why would they make a decision based on where the front month is?
Well, Don, I got to tell you, they are making that decision. They have announced that they're going to, several of the majors who are the largest holders and drillers in the Permian and in other shale basins, have said that they are increasing capex. I think Exxon said 25%. They're going to increase production. Total U.S. production is going to grow by about 10% by that 900,000 to 1 million barrels. It's just that these things don't happen overnight. You know that the decision to spend money, billions of dollars to bring up production, doesn't mean production comes on the next day. But I want to address the point that you said, because I think the president was very clear. We're not taking a broad swipe of the whole industry. He said he wanted to acknowledge the fact that part of the industry has done exactly what it needs to do, and to see high oil prices, incentivizing them to bring about more production. Other companies, and we can't ignore this, Jonathan.
Yeah.
Some companies have said, and the quote that he used in his speech, that even at $200 a barrel, I will not increase production because of so-called fiscal discipline. That is not, I'm not making that up.
No, I know you're not. Amos, to be fair to you, just let me jump in. To be fair to you, that was a comment on this network. I heard it. I talked about it. I repeated it. It's something I've said before. Another thing I've highlighted as well was a Wall Street Journal report that came out in the last few weeks that the administration is trying to make a call. to the Saudis in Riyadh, trying to arrange a call with the Crown Prince Mohammed bin Salman, and they won't take the call. Now, I spoke to a member of OPEC, and you can respond to that in a moment. I spoke to a member of OPEC this week, and I thought it was utterly embarrassing for them that they had a meeting earlier this month that lasted 13 minutes, and one just yesterday that was at 1 minute shorter. Now, I wonder if it's more embarrassing for us that they're laughing in our faces and doing this. Now, you speak to the Saudis. Talk to me about it. A, is that false? Did the administration try and arrange a call with Crown Prince Mohammed bin Salman and the President of the United States? And B, why are their meetings lasting 13 minutes if we're in a massive energy crisis?
So, one, there was a call that was going to be arranged between the president and King Salman, and that call did take place. Those reports, I'm seeing constantly reports of Saudis snubbing the U.S. or I think there's an interest in certain quarters to bring about this kind of narrative that is completely false. I've been to Saudi Arabia on a number of occasions over the last several weeks, on a couple of months. On a couple of occasions, I was told what the Saudis told me on the front pages of a U.S. newspaper about 3 hours before the meeting started. And I showed the Saudis the headline so that we can jointly comment about the hyperbole of the press on this. So I would really relax. I don't think there is the relationship between the United States and Saudi is strategic. We have a lot of issues that we need to work on together. There are complexities in that relationship that we are working on. We have a lot of issues that are of common interest, fighting terrorism, that Saudi has had to suffer through over the last several weeks, specifically from the Houthis. We have a lot of strategic interests elsewhere in the region, and as well on energy. And I'll tell you that we're having very good discussions there. The press and reality on this one are really far apart. On OPEC, look, I was asked before the OPEC meeting if we had a message to OPEC, and my answer was, I have no message for OPEC. These are folks that know the industry, they know the market, they know the supply and demand. I must have a difference of opinion. We believe that, not just believe, but I can see the physical evidence that the market is short about 2 million barrels a day, if not more, from Russian supplies into the global market. That is clear to me. We can see that. Obviously, some perhaps in OPEC don't see the shortage of supply, but I can understand that it's a complex issue for them with the OPEC versus OPEC plus. I think that's they're going to have to take some time, and perhaps if you're not going to discuss the issues very seriously, perhaps 11 or 12 minutes is all you need. But at the end of the day, they've done what they needed to do, and they've increased production announced that they're going to continue the increases of production. We don't think that's right. The president is not asking other people to do the work that we should do. He took action yesterday by himself on behalf of the U.S. government for the American public of releasing 1 million barrels a day. I believe, by the way, Jonathan, that we're going to have additional capacity coming online from our allies. And the president coordinated this release, as he has all other measures against President Putin, with our allies when he was in meetings at the G7 and the NATO summit last week. He's discussed it with leaders even earlier this week. I've had conversation with my counterparts, and there's a meeting that is going on right now of the IEA, the International Energy Agency, to look at additional releases from the international market. So we won't just have oil coming on the market in the United States, but rather have oil coming online into the market in Asia and as well as Europe over the next several months.
Amos, you're a professional. You've given us tons of time, and that's valuable to me. You know that. Thank you very much. I appreciate it. Amos Hochstein there of the U.S. administration on the situation right now. And Tom, it's a complex, nuanced conversation.
It is complex, but every single oil pro really pushes back against the idea it's easy to boost production. There are huge reality constraints within the Middle West of this nation on labor, on concrete, on steel pipe, and on the tangible stuff that you actually have to do at the margin.
The payrolls report, Tom, 12 minutes away.
Payrolls report 12 minutes away. Randall Crosden will join us. But first, Nadia Lovell, too short a visit with UBS, I should say, their senior U.S. equity strategist. Nadia, office jobs report is a reality of an inflation study. What do equities do within higher inflation?
I think the equity markets will be choppy going forward from here. Of course, everyone is watching the inflation numbers. We are expecting inflation to peak in the next month or so. For March, we're looking for 8.5% for CPI, and then we're looking for some moderation to 6.5% for April. And so a lot of this will depend on where commodity prices go, but also we are closely watching what the Fed is going to do right now. We're looking for rates to be front-end loaded. We're looking for 50 basis points in May as well as June, and then a return to a 25 basis points cadence. And so we think that the market can be able to weather that storm.
Nadia, we just heard from Amos Hochstein of the State Department talking about oil prices and how that's feeding into consumer spending power. How much does that play out in the expected earnings reports that we're going to get within the next few weeks? How much deterioration do you expect in the margins?
Well, that's something that we're watching very closely. We have seen that the resiliency of margins the last couple of earnings seasons, company has been really able to pass along those costs. So we've been listening very closely to hear if they're hitting any resistance level. We think that is going to vary. You know, in the last couple of weeks, we've seen airlines lift their guidance on strong demand despite the higher fuel prices. We've heard a similar tones from the lodging and gaming companies. You know, through this week, we also heard from a luxury home retailers, demand has softened owing to the war. And so there might be some shifting of sentiments, but this might be also further indication that spending is shifting away from goods and towards services. So there's some mixed signals. And so we'll be watching very closely at the earnings season to reconcile some of these differences and also to see where margins are going to go. But near term, we think margins will be able to hold up.
Do you think that stocks have gotten too concerned about rate hikes or not concerned enough? As a lot of people talk about this dissonance between bonds and stocks and what they're pricing in terms of Fed action.
So you've seen a repricing of risk assets. Of course, this year we've seen the valuation multiple for equities come down from 29.5 times back in November to about 19.5 times today. So we think that's fair. We think that the reaction that the market has is fair in that repricing. In terms of what's going on in the bond markets, you know, obviously the 2-10 spread inverted yesterday. And so, but we do think that that's sending somewhat of a false signal. We know that inverted yield curve tend to precede recession. It has done so in the last 8 recessions, but it isn't great at predicting timing of a recession. Usually it takes about a lead time about 15 months. And so we think the predictability power of the curve in this cycle is not as good. It's more important, we think, to look at the 10-year, 3 months, which is a better indicator that we're watching very closely.
2s10s right now, just short of 2 basis points. Nadia, thank you. Nadia Lovell there of UBS. Tom, futures going into this one, up 0.5% on the S&P, and the bond market yields are higher on 10s by 6 basis points, just short of 240.
In 2s10s, still near that flattening here, 0.93 on 2s10s this morning. This is a joy because it is a symbol of the end of this pandemic. The University of Chicago Booth School celebrating the opening of their London platform built during a pandemic with the leadership of Randall Krosner. He's a former Fed governor and, of course, professor at Booth. Randy, it is a sign of a pandemic opening. We just spoke to Amos Hochstein of the White House, of the State Department on energy. How much of the mystery of this second quarter is about a booming nominal GDP and a booming American economy?
I think you really nailed it there, because the key issue is how much demand is there going to be that's going to be driving price pressures, given all the supply constraints that we have in the world. We have the ones from the pandemic, and now with the war in the Ukraine and sanctions, that's only increasing the supply tightness. And so that's exactly the issue that the Fed is going to be facing.
And what they face, Governor Krosner, is the idea of moving from 14.5% nominal GDP down to, let's call it 5 or 6-ish. I don't want to do your job. And I guess the game is to get nominal back to 4 or 5%. Good luck with that. How does the Fed's job change given substantial combination of real economic growth and inflation? It's different, isn't it?
Yeah, this is really the biggest challenge that they've had in decades, because, as you know, we were at 40-year highs in inflation. The economy is still going pretty strong because of the pent-up demand from the lockdowns and from the pandemic. but they need to raise rates, and they are going to be raising rates. The concern is that did they wait a little bit too long, and now they have to move higher quicker than they otherwise would like, which potentially could slow things down in the second half of the year or next year. It's a pretty tough trade-off that they have.
So which would you prefer, Randy? If we had this binary choice of either allowing inflation to run a lot hotter or having a bigger risk of recession, which side would you err on?
They've got to rein in the inflation. And so hopefully they can do that in a gentle way. And I think they'll be cognizant of what the consequences of the war are, what the consequences are of other shocks in the real economy. But we saw what happened in the late 1970s. We don't want to have to raise rates to double-digit levels in order to try to bring in inflation because inflation expectations have gotten out of control. Fortunately, they haven't so far. One of the reasons that the yield curve is so flat is because the 10-year is signaling we don't have that much of an expectation of high inflation. Same thing with the Treasury tips. But that's that's something that's quite fragile, and that could move up quickly. And so the Fed needs to act sooner to make it less likely that they have a recession.
Randy, we're about less than 5 minutes away from the jobs, the payrolls figure for the month of March. Are there numbers that could actually get the Fed's attention and cause them to move even faster, or what numbers would actually move the dial in this front?
I think one of the things that they'll be looking at is what's happening with wages, but I don't think there's going to be enough to move the dial on that. Certainly, they'll be looking at labor force participation and the employment population ratio, which has been moving back up after falling precipitously during the pandemic. So we're starting to get more people back into the labor market, which is a good thing. And part of that is because some of the savings is starting to come down. We sent out checks to an enormous number of people. They're starting to spend that. That's coming down, and so some of those people are going to come back into the labor market.
Randy, you're going to be teaching all this in London, at London Booth or Booth London, whatever. I can't remember what the branding title is. Is any of what you did at the Fed in the textbooks you're going to use? I mean, we seem to be in such original place this Jobs Day.
So a little bit of it is some of what we had from the past in responding to the financial crisis and what the Fed did so the central banks in response to the pandemic. Some of that's in there. But this challenge of such strong growth, such high inflation, we really haven't seen that in a while. Some of that's there. But what's fun is I get to talk about some of the experiences from the time of the Fed, and it's really engaging with the students.
Randy, what would you do if you were looking at the balance sheet? We've had a lot of back and forth over how quickly they're going to reduce it. How does it play in this sphere?
So I think that's something that I think what they're going to do is want to run that in the background, much like the Fed did previously. They want to make the interest rate policy the main tool and the main thing that people focus on. And I think they'll gradually reduce the balance sheet. I don't think they're going to do anything shocking with that, partially because of all the uncertainty in the markets. I mean, look what happened in the nickel market and the London Metals Exchange. A lot of disruption there, a lot of potential for disruption in other markets. So we certainly don't, the Fed doesn't want to pull out too much liquidity too quickly.
John, that's pretty cool. The guy goes over to London for a cup of coffee and he's quoting LME.
You know how that works.
You know.
There's just that London buzz.
More than a cup of coffee, Tom.
How long have you been there, Randy, now? How long have you been in London now?
I was in London 2.5 years. I'm actually back in Chicago now because we had the official opening. It was really great. And so I'm back in Chicago for a bit.
Very cool. Well, welcome back, Randy. Thank you. Randy Krosner there of University of Chicago Booth School. About 2 minutes away from payrolls, Tom. The estimate 490. Should we get it set up and go through the market? Futures positive about 0.5% on the S&P. On the Nasdaq up around about 0.5% as we kick off Q2, leaving Q1 behind. The first quarterly loss on the S&P 500 going back 2 years, believe it or not. Last month though, pretty decent. The month of March, a decent month of gains on the S&P, even with this happening in the bond market. Yields higher again by 5 basis points on a 10-year to 239, and the move we've seen on the 2-year last month was huge, up 90 basis points on the month, 160 basis points on the quarter, Tom. And this morning, yields pushing higher again on a 2-year, up 4 or 5 basis points to just short of 240, 238.
Anybody speaking with certitude out 90 days, John, or out even 1 week, they're dreaming. All I can say is it is absolutely original that we've got 6 or 7% nominal GDP in America. No one knows where we're heading right now. We can guess, but we don't know where we're going.
What people are feeling, though, Tom, is the 7% inflation number, pushing 8% and might go through it on April 12th. That's a similar story in Europe now, driven by energy prices. And Lisa, didn't that get your attention? Before we switch our attention to the US exclusively, in Europe, to have CPI 7.5%.
It's unheard of, especially after there was this big rally to try to get inflation up to 2%. Well, that kind of got blown past. At what point does this become a global phenomenon that feeds on itself, and how much can the consumer really take?
The jobs number is 22 seconds away. The range is wide, wide, wide. It always is. It's anywhere from 0 at Pantheon to 700K at Landesbank. That's the range. The median's 490K. The number drops in about 10 seconds. Going into it, futures up 0.5% on the Nasdaq, up 0.5% also. In the bond market, Treasury yields are higher to 238.95. With your jobs report, here's Mike McKee.
Good morning from Washington, John. And the numbers not quite as good as anticipated, but still strong. 431,000 jobs were restored. We're still in the restoration period, shall we say, during the month of March. And the unemployment rate drops further than we had anticipated, 3.6%. So the labor market remains very strong in the U.S. The payroll revision, 95,000. So add 95 to that 431,000, and you end up with over 500,000 over the last 2 months, which is very, very strong numbers. The only thing that we're not clear on is how that's going to affect the Fed, because with unemployment at 3.6%, average hourly earnings go up 5.6% on a year-over-year basis. That's a tick more than anticipated on the back of a 0.4 rise, just as forecast by economists in the month of March. The labor force participation rate goes up a tick to 62.4. That is what was anticipated. So more people coming out to look for work, more people getting jobs, and more people getting more money for those jobs. It's a good news story for the labor force, but maybe a bad news view on inflation.
Here's the first move in the bond market. Yields up just a little bit more. 2s, 10s down to a little less than 1 basis point. Let's whip through it. In the equity market, we stay elevated, up 0.5% on the S&P and on the Nasdaq 100. Let's call it 0.4% higher, up 8 basis points on a 10-year. Your 10-year right now, 241.89. Tom, the difference between 2s and 10s at the moment, a little less than half a basis point. I think we should just call it 0.
John, I got the old HP12C out here, and here's the number you got to focus on with a 95,000 revision. I believe the math is 526,000 with the constructive revision, and that again speaks to 3.6% unemployment rate. I mean, the numbers speak for themselves.
How about that unemployment rate? Mike McKee, speak to that and speak to what the Fed is expecting this year and next, because their number for year end's 3.5, I think, for the next couple of years.
Yeah, the Fed is expecting 3.5% once we get there this year, next year, and the year after. Ticks up to 3.6% before eventually settling at 4%. But it's going to be a long time until we get there. Now, take a look at the numbers behind the unemployment rate this time. The number of people in the labor force increases by 418,000. That's the biggest in 2 months. So a lot more people getting out there looking for work. Employment rises by 736,000. This is in the household survey, not the establishment survey. And unemployment falls by 318,000. So more people in, more people finding jobs. That's why the unemployment rate falls. And we used to call that good news. Again, everybody keeping an eye on the overall wages, and the Fed going to worry about a wage price spiral. Taking a quick look at some of the jobs that we got: leisure and hospitality, 112,000, still growing. Food services and drinking places, 61,000. Professional and business services, 102,000, and retail, 49,000. And we heard some stories about factories not being able to keep up with their orders because they couldn't get enough people. They added 38,000 jobs in March. So broad-based gains, not as large in some categories as we had been seeing, but more categories with large increases in March.
Mike McKee, thank you. Tremendous jobs report, Tom. 431. It's a slight miss on a headline number, but look through the rest of the report. Unemployment down to 3.6%, wages climbing higher in a material way, actually, 5.6% year on year. I imagine to kick off an interview with Secretary Walsh, Tom, in about an hour or so, we'll see a happy man. down in Washington.
Absolutely. And the social good of the underemployment rate under 7% is there. It was 6.8% was the best pre-pandemic. We're back to 6.9%, just a little bit of a difference there. And on a social statement, which Secretary Walsh is going to focus on, John, yes, it really speaks to a not fully employed America, but certainly the trend is your friend. Our friend on Jobs Day, Jeffrey Rosenberg, joins us, portfolio manager, systemic multi-strategy fund at BlackRock. Jeff Rosenberg, we went curve inversion off of this, now -1 basis points. Let's go back to Carnegie Mellon and talk to me about the nuances and disaggregation of curve inversion. There's zero. There's a little bit inverted. Maybe there's more inversion. What is that nuance within this boom economy?
Well, Tom, this report is just reaffirming what the markets were expecting and that trend that you were talking about in terms of the bond market of yield curve inversion. You know, no surprises in this report, as Jonathan just mentioned. The headline report, the headline number miss is really minor. It's the strength in the labor markets that's being seen here again, and that's the challenge for the Fed. For the markets, as we're seeing a little bit this morning, a little bit more curve flattening, it is really much more about, as Mike McKee was kind of highlighting, you know, this is good news, but it's a little bit too much of good news. And this is an economy and a labor market that's overheating. The Fed has to accelerate. Lots of expectations. We talked about at the top of the show some historic bond market and really financial market losses in the first quarter. This is the markets readjusting to a much faster pace of Fed normalization. And today's report only will reaffirm that view, and that's what we're seeing with that little bit of flattening continuing in the market that you're talking about.
Jeff, for you, is this good or bad news when it comes to investing?
To investing, you know, I think it's just a reaffirmation of our expectations. Not good news or bad news, but just this is what we expected. And what we expect is this is a very difficult environment for investing because of the challenges of the dual aspects we're about to go into. We're talking about for the May FOMC, you know, the shrinking of the balance sheet and, you know, markets are pricing in a move towards a 50 basis point hiking cycle. This is a very, very dramatic turnabout. That's why you had such a negative price performance across fixed income in the first quarter, because we're waking up to the idea this is a Fed that wants to get out in front of the curve, and that means a very accelerated pace of tightening. That's a challenging environment for investing, as we just saw in the first quarter. When we get to the backside of it and to some higher rates of real interest rates eventually and higher levels of yield, this will be an attractive environment. But the transition, it's a very difficult environment for investors, as we saw in the first quarter.
Do you think that it's basically a lock that we'll get to, we'll have 1 percentage point increase in the Fed funds rate by June?
You know, I wouldn't say it's a lock. It's definitely well, it's about 90% priced in terms of the market. You know, you can't say it's a lock because obviously some things can happen in the geopolitical side that we're all focused on. If that were to take a more dramatic turn that you saw in terms of risk-off environment, confidence shock, you know, the shocks can be important. And financial conditions tightening, which to date is been accelerated but is still on the longer view, very accommodative markets. If you had financial markets kind of get really far ahead of where the Fed wanted to go, you could certainly slow that pace. So I wouldn't say it's a lock, but given what we know today and the fundamentals of the economy, what we see out of this labor market report, I think the odds are very high that we're going to have 250s back to back in the May and June reports.
Jeff Rosenberg, I went logarithmic on you. I've got to do that when you're on. And the answer is the Bloomberg U.S. Total Return Aggregate Index is not a bear market, but -8% is -8%. Are we in a bear market, or is that what awaits us in the bond market Q2?
You know, the good news on the fixed income market
Give me some good news.
Bear market. The good news is that we very quickly reprice the expectations and term premium and inflation expectations. So the repricing is the painful part. That's the negative 8%. But fixed income, you recall, the key to returns is the level of income. And so why you had such negative returns was you were starting at very, very low levels of starting income. So as we fast forward and you're at higher levels of income, it really gives you a lot more cushion to subsequent increases in interest rates, and that pace of negative returns is much harder to repeat.
So then what do you do on a strategic standpoint? I mean, if you're systematic, did you shift from full faith to credit, or move? You know, did you go to loans? I mean, what do you do here within a strategy of down 6%, 7%?
Yeah, you know, a couple of things here. First, in terms of kind of the directional part of our strategies, you know, the front end of shorter maturities have certainly looked much more attractive coming out of this environment. The repricing, that curve flattening that you talked about, well, that's really about restoring the cushion to fixed income investing. And where do you see that strongest across the fixed income landscape? It's really in those shorter maturities. So that's an aspect of our investing that we think is an opportunity going forward, where there's more cushion from further increases in interest rates. And then in our investing, you know, our toolkit is both the kind of directional view that I just described, but also looking at things that take out direction and look in the cross-section of investing. And there what you're seeing is a lot more opportunities to invest in dispersion. We invest in both the equity side and the fixed income side. And there you're really seeing more alpha opportunities. So it's shifting your mix, your weight in your portfolio of where you're getting your returns from. A little bit less out of directionality, because directionality, as you highlighted in the beginning of the show, this is impossible to forecast where we're going. But the dispersion in the cross-section is actually increased. It increases the opportunity to alpha investing.
Jeff Rosenberg of BlackRock. Jeff, great to get you to react to what looks like a really strong payrolls report. And looking at the movement off the back of this, yes, a small downside surprise on a headline number, but that's not the story here. This is solid pretty much across the board, everywhere you look. 3.6% unemployment rate, down from 3.8%. Wages higher year over year by 5.6%. Yes, more work still needs to be done there for sure. And look at the move in the bond market, Tom. Up 9 basis points on 2s, up 8 basis points on 10s. We've got an inverted yield curve. And coming up, a conversation with Rick Reeder of BlackRock, Anastasia Amoroso of iCapital, Mike Collins of PGIM Fixed Income, to get his thoughts of whether he'd be a buyer here in the Treasury market. And later from the White House, Tom, Secretary Walsh.
We're going to open up the conversation here. Right now, let's go back to Mike McKee with his first reading, where he gets a moment to actually breathe and look at the data. Mike, what is the distinction at 8:41 a.m.?
Well, one good news piece for Tom, for the Federal Reserve, is that they had put in this new framework to try to bring down unemployment for minority groups, and they were a little concerned about having to abandon that to fight inflation. But the unemployment rate for Black Americans now down to 6.2%. It was just in the 5s before the pandemic started. So getting close. That was a big drop from 6.6%. For Asian, 2.8%. which is the lowest category of all whites, come in at 3.2%. And for Hispanics, it is 4.2%. So everything dropping on that side. And it looks much better for the Fed in terms of having to retreat a little bit from running the economy hot.
Very good, Mike. Thank you so much. A headline coming out now, and I want to give some background to this. Capital Group of Los Angeles, the Lovelace family, and what they've done for decades, is truly one of the great activist managers. They activated last week, and the report is they are seen as a seller of that ginormous block of Barclays shares. It's very important for our global Wall Street audience to identify that with the Capital Group of Los Angeles. Right now, Tina Martin-Adams joins us now, Chief Equity Strategist for Tina Strategy at Bloomberg Intelligence. March, in like a lion, out like a Tina. I mean, is that all that happened? Is there's no alternative in Tina Martin-Adams' world?
Well, I think that is certainly part of the story. Early March, we clearly got very oversold on the equity market. We were at that point pricing in probably some degree of stagflation emerging, pricing in some degree of unemployment rate increase later this year, pricing in 7 to 8 hikes by the Federal Reserve. And very high oil prices into perpetuity. So some of the release of oil prices moving lower has certainly created some optimism in the equity market that we're not going to experience some sort of stagflationary malaise emerging in the market. We're still somewhat weak. I mean, obviously stocks are down on the quarter, still in a bit of a struggle with rates, and the overall inversion of the yield curve is still a big topic of conversation. Margins still struggling to provide any momentum to the market. So some of the issues that we started this year watching are still there.
What's the level of guessing on your August floor? I walked down on your floor the other day. Everybody's dressed in black like it's Goth Tuesday or something. What is the struggle to guess margins in the next 90 days?
You know, I think analysts have very much had a difficult time struggling with margins for the last 6 months. It's not really specific to this quarter. It's been going on since September of last year, where they've modified their forward forecast, and then companies come in and beat that forecast, and then they modify it down again, and then companies come in and beat. So it's a lot of give and take on the margin lines. What we're seeing in the aggregate right now is a lot of stabilization has emerged in margins over the course of the last month. And that may be one of the hidden reasons why the equity market is starting to celebrate a little bit, or at least release some of that anxiety that emerged in February and March. But that said, it's still very sector specific. You've got some sectors like consumer discretionary, industrials, the communication services group, really experiencing downward pressure on margins still. And I think the wage numbers that we got this morning are only going to confirm that.
I've been doing this for 4,000 years, and to this day, when somebody says consumer discretionary, I have to think really hard. What is that exactly?
Exactly. Is Apple considered a consumer discretionary, considering that it's currently a staple? But Gina, in some ways, the Fed does not want to see profit margins hold in. I keep harping on this because I was listening to Fed officials, and they basically were saying that it's concerning to them if they can see ongoing ability of companies to pass along the price increases to consumers. What's the risk that good news for equities in the short term, in terms of earnings power, actually leads to bad news longer term because the Fed will be more aggressive?
Well, I think it depends upon the degree. As with everything, Lisa, it's really a matter of the degree to which companies are able to pass along price increases. I mean, the broader data picture would still suggest that PPI is running hotter than CPI. Margins stopped increasing, or margin expectations stopped increasing 6 months ago. So to the degree that indeed the Fed does want to see some slowdown in price pressures and maybe push back a little bit, we are seeing that emerge in corporate earnings. I mean, it's a dance, though, because ultimately, how much do you compress margins for corporate earnings where they ultimately start cutting headcount is the big question. And I think that's what the market is struggling with right now is, yes, some margin rationalization makes a lot of sense. Yes, we are experiencing that in the numbers, but you can only go so far before ultimately you have a real impact on the economy. Margins are a pretty good leading indicator of either weakness or strength in the overall economy, because let's not forget who actually hires the labor. Right? That's the companies themselves. So they can only push so far.
Gina, I'm so glad you're here, because right now we're looking at an inverted 2-10s yield curve. Everyone's going to be talking recession. People are going to be gloomy. And you're talking about incredible resilience and profit margins, incredible strength in companies. How quickly could that shift if there is something where you start to see companies cutting employees, cutting headcount instead of paying the higher wages? How much is that realistic versus a pipe dream of the reality of a corporate America?
I think it's pretty unrealistic right now. Companies instead are telling us they can't get enough labor to support demand conditions. As a general rule, I think certainly industry by industry, again, you get different stories. But as a general rule, companies are increasing wages because there is not enough labor to fulfill demand conditions as they exist today. I think one thing you really also watch, Lisa, frankly, is top-line growth. I mean, revenue growth for the S&P 500 is still running at a double-digit pace. There still is a tremendous amount of volume sales. I think we'll see a slowdown in housing, maybe a slowdown in some of the rate-sensitive sectors that'll help rationalize overall revenue growth conditions. But we're a far cry yet from companies starting to lay off workers. For that, we really need to see much greater margin constraints emerge or top-line growth slow down.
Gina Martin Adams, thank you so much. The Bloomberg Intelligence. I don't envy at all the work they have forward here into earnings season. I think John Farrell mentioned mid-April we begin with JP Morgan. Right now I want to go back to Michael McKee. Michael, this is a bit tangential, but Gina Martin Adams just mentioned it, which is the housing economy. A lot of buzz this weekend, into the weekend reading, on higher mortgage rates. Does Chairman Powell care about a fully employed America and higher mortgage rates?
Well, he's looking for higher mortgage rates because he'd like to slow the housing market down. Housing is contributing more to inflation than almost anything at this point. We're seeing month after month 0.4 gains, and the private measures like Case-Shiller were up 19% last year for the United States. Interestingly enough, one of the things constraining builders has been labor, but they found 38,000 employees for the construction industry. And I was just looking through, I'm going to page down and get it again, the interesting number in terms of categories of people who got jobs, a big increase, 18,000 in real estate. So it looks like maybe one of those peak things where everybody comes into the market just as the market tops out. We'll have to see.
Well, what are you going to be looking for in April? I mean, we're dashed to a new quarter, and we've got important economic data before the May 4 meeting. Do you look at housing data, or is there another way to gauge the housing frenzy we're in, Mike?
Well, look at housing sales data and prices to see if home prices are still rising at the same kind of rate. The Fed has pushed mortgage rates up above 4%, and we're still seeing strong growth. That should start to slow. There are anticipations of that. We'll see if that comes through before the next Fed meeting. We don't get another employment report before the next Fed meeting, though. The April employment report comes 2 days after the meeting.
Lisa, to me, this is so important, and I can't gauge it. I look at home prices, for sale prices, and my jaw drops. I don't feel the same way about the stock market, but I look at the housing market and I go, you've got to be kidding me.
Yeah, well, that goes to what the Dallas Fed was talking about in their recent report, where they're saying the same kind of froth, the same kinds of exuberance in the housing market that they last saw in 2006, and this is feeding into rents. The multifaceted aspect, Tom, of this inflation is what has so many people focused on wages now catching up. How long can this persist?
We will see. Right now, we finish strong in this hour with Ira Jersey, Chief U.S. Interest Rate Strategist here at Bloomberg Intelligence. And, you know, Ira, it was such a joy to have Dominique Constant on today with this new opportunity at Mizuho. I mean, a great capture by Mizuho to bring in the guy you worked with at Credit Suisse years ago. And what I got from Dominique is it's a changed landscape. In your world, it's about higher yields. And I want to go, Ira, all physics envy on you right now. Once yields get underway, is there an inertial force where they just keep going higher?
Well, I don't think that they'll continue to keep going higher forever. But at the same time, you know, we put out a report last week where we noted that we could be in for a very significant sea change here, where this 40-year downtrend in yields is probably over. Now, that doesn't mean that we're necessarily going to regress and have a 1970-style sell-off necessarily, because I think the Fed is going to be aggressive enough that we'll have inflation expectations, you know, not go up much more from here. But we could have much more persistent 2.5%, 3.5% 10-year yields, as opposed to, you know, 10-year yields rallying 150 basis points every year, basically, for a better part of 10 years.
Ira, everyone's going to be talking about the yield curve, that benchmark plain vanilla 210 spread, the gap between 10-year Treasury yields and 2-year Treasury yields that we've been talking about all morning. It is now inverted. It is inverting further as we talk. The clear direction seems to be what everybody was worried about. Do you buy the Fed's argument that this yield curve doesn't really matter, and that if you look at others, particularly in terms of the very short-term debt market, it's actually looking much more constructive?
Well, so here's the thing, right? When the Fed looks, they say, okay, in the next 12 months, are we going to have a recession? Even the 2-10s curve doesn't tell you that. The 2-10s curve is more 12 to 18 months out. Will you have a significant slowing of the economy, if not a recession? And the answer to that is yes. And look, it doesn't work every time, but it's worked 5 of the last 6. So I'll take the bond market's call on that. The front end curve that they look at is going to invert, and it's going to be very flat a year from now. So I think it's all very consistent. If the Federal Reserve hikes as the market is currently priced, so 7-8 times this year, and you know 9 times over the next 12 months, we're going to have a completely pancake flat curve, and that's what the market's pricing. The market's pricing for the 2-10s curve to be inverted by about 17 basis points this time next year, and you know, like I said, 5 of 6 times that's led to a recession within the not too distant future. So it's not imminent. It's not this year. It's not 2022, but late 2023. summary, I think that we're probably going to see a pretty substantial slowdown, if not an outright recession.
Ira, we were talking about whether perhaps the hawks have out-hawked themselves over the past 2 months as we look at the 2-year yield and how much it's climbed over the past 4 weeks. Do you think that the argument is now perhaps they need to go even further based on some of the momentum that we're seeing in these numbers?
Well, obviously, it depends on where the data is, I think, in the next 3 to 6 months, because keep in mind that even though we have, relatively strong jobs data, that certainly will make the momentum of inflation maybe a little bit stronger than we had thought a couple of months ago, for sure. And service sector coming back is going to be a big part of that. So we weren't worried about inflation until we started to see services prices going up, and a large component of that is wage gains in those sectors. And this morning's report confirms that, yes, wage gains in some of those services sectors are still pretty robust, and that means that you can have maybe 2.5% persistently than we did the past decade.
This Jobs Day, Lisa Abramowitz and Tom Keene, we welcome all of you on Bloomberg Radio and Bloomberg Television. We mop up the hour with Ira Jersey on fixed income and our Michael McKee looking forward to May 4 and then on to June 15 is the Fed meetings. Mike, I look at what the bond market says, and what it says is big jumps and big uncertainty. How does the Fed react to 10 basis point move, 8 basis point moves in full faith and credit debt?
Well, if somebody promises to sell a bond or repo a bond and it gets delivered, the Fed's not going to worry about it. They'll only worry about it if it's a problem with the system itself. At this point, the Fed is expecting to see rates go up, and there will be a lot of volatility as people try to combine the numbers with what they think the Fed is going to do. And you can see that today because now people are starting to think the Fed's going to have to move even faster because this report is really strong. The Fed can't do anything about that, but they aren't going to worry about it unless there's a systemic problem, as there was last March. March 2020.
Does the Fed or anyone at the Fed, including their wonderful research staff, do they care about nominal GDP, or are they still wedded to 20, 30, 40 years of inflation-adjusted GDP analysis?
Well, they'll look at the inflation-adjusted GDP analysis because they can separate out inflation from that, and that's a different problem. There are people who think the Fed should start looking at nominal GDP and try to control interest rates by using that instead of the Fed funds rate or the target range. But at this point, that's not gotten any traction among the Fed.
Ira, going forward, what are you looking at in terms of data that will be instructive as to the Fed path? I mean, or is it really baked in at this point, and we're just going to wait and see after those initial 50 basis point moves?
50 basis point moves, but certainly a 50 basis point move in either May or June, I think is pretty likely. But ultimately, I think the second half of the year is going to be much more constructive because, we didn't see significant interest rate hikes. We haven't seen, what's going to happen with the housing market, for example. Will we see a significant slowing in home sales and a deceleration in home prices significantly? So I think that right now we have to consider, look, the Fed's going to hike another 100 or 150 basis points before they actually consider, whether or not they're going to slow down. And by then, by the third, fourth quarter of this year, we'll have significantly more data. And it's all the data you think about, right? The payrolls report, obviously, the CPI and PCE reports are going to be of very, very strong interest to markets. And keep in mind, the market is still pricing. When you look at inflation break-evens, the market is still pricing for inflation to be much lower next year than this year, but it's not going to be at 3% where we were pricing 2 months ago. We're now thinking that the inflation is going to be well above 3% at the end of the year, and that should still keep the Federal Reserve relatively hawkish.
Ira, how concerned are you about liquidity in the bond market, especially as the balance sheet comes into play?
Very. So Sean Savage from our market structure team and I have done a lot of work on this, and liquidity is very, very poor. Dealer balance sheet just can't absorb all of the selling pressure that's coming out of the market as we get these sell-offs, which is one of the reasons you're seeing these 10 basis point moves, whereas before they might have been a 4 to 5 basis point move. You're getting much more realized volatility, and that's something that we think will continue and maybe even accelerate when the Fed starts to reduce its balance sheet, and there'll be a lot more treasuries available to investors.
That's That's exactly where I want to go in the next conversation. This is a gift, folks, to have Michael McKee with us, running all of our economics coverage in Ira Jersey of Bloomberg Intelligence is a really wonderful way to go. Lisa, we didn't get to it, but what Mr. Jersey just mentioned there about the balance sheet dynamics of the ECB and the Fed, and forget about Japan, let's assume nothing happens there, but wow, the balance sheet dynamics got to be front and center.
And how much does that get accelerated as well? And do we have any template for what that looks like? Aggressive rate hiking on the one hand, in addition to reducing balance sheet. Oh yeah, and by the way, that's what's happening around the world. It's not just the Fed, it's also the ECB. That sort of dueling action with very different economic backdrops. I'm just trying to square what Gina's talking about with that strength in corporate America and the pessimism in bond markets, and trying to square that into how this plays out over the next 6 months is very difficult.
My measurement here, Lisa, after the historic 90 days we've had, and we must say thank you to our team that have just killed on getting us voices and guests to make this historic time seem somewhat sane, is the uncertainty is off the chart. I was uncertain on January 1, the Ides of March. Here we are, and I'm uncertain going forward. I just don't know what to think.
And people are talking about regime change in terms of inflation, in terms of rates, in terms of geopolitics. How do we chart that out?
Our regime change is we'll have a conversation with the Secretary of Labor, Martin Walsh. Look for that coming up on Bloomberg Radio and Bloomberg Television.
What a jobs report from New York City this morning. Good morning, good morning. With equity futures just a little bit firmer to kick off Q2. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, the Fed under pressure.
How high does the Fed have to hike?
The jobs data this week, that CPI headline inflation.
Data dependent is certainly the name of the game.
The Fed will try to be data dependent.
They go 50 in May. That's the new hike.
The markets, from a pricing standpoint,
suggest that there's a 50 basis point hike on the horizon.
They're going to do 50 basis points. Why wouldn't they?
This is really a Fed now that is in inflation fighting mode.
Inflation is going to be absolutely insane for March.
The Fed is very much keen on front-loading these rate hikes.
It has to hike until there's some kind of pain.
The Fed is late. The Fed knows it's late.
Call me when we get to 3% in inflation, and then they'll stop.
They do have to move pretty aggressively.
Joining us now is Mike McKee down in D.C. Mike McKee, this one looks solid.
This one is solid, John. We had a lot of hiring going on in the month of March as employers continue to try to staff up. 431,000 jobs were created or restored in the month of March. That compares with 750,000. That's the revised number. You can see 95,000 added to the numbers this time, which brings you to 526 new jobs that we didn't know about last month. Interesting thing is you have to go back to last July to see a number that wasn't revised higher. So 431 may be only the starting point for the March numbers. Unemployment drops to 3.6%. A lot more people come into the labor force, and we see a lot more hiring than unemployment. The participation rate ticks up to 62.4%. The Fed wants to see that. Average hourly earnings tick up to 5.6%. The Fed does not want to see that. Where were the jobs? Leisure and hospitality, bartenders, waitresses, and people working at hotels coming back to work, 112,000. Not quite as many as last month, but when you look through this report, it's a lot of jobs created in a lot of different areas. So a broad report instead of just a couple areas. Professional and business services up 102,000. Those are the McKinseys and Boston Consultings and the H&R Block accountants, that sort of thing. Retail, 49,000. Manufacturing, 38,000. Now let's go back just before I leave you, John, and show you the problem for the Fed. When unemployment falls, we know wages rise. Historically, that's been the case. You can see the circle in the middle there. That was 1999 when we got down to 3.5% unemployment. You can see wages rose and inflation rose. But then go all the way over to the right-hand side. Look at where wages and inflation are now as unemployment gets back to the same level it was in 1999. What is the Fed going to do about that? Do they think it's unusual because of the pandemic can they bring down the wage level and the inflation level fast enough that it doesn't get embedded in society?
Mike McKee, thank you, sir. What a meeting we've got coming up at the Federal Reserve in early May. Joining us now is BlackRock Global Fixed Income CIO, Rick Reeder, and a whole lot more over at BlackRock too. Hey, Rick, just react to this one. Wow, it looks decent.
Wow, it looks decent. I mean, the data is really strong. By the way, people, when they first saw it, said the 430,000 or so jobs was a little below expectations. You know, what people have to start factoring in is there's just not enough people to come back into the workforce. So I was looking at the data this morning. There's 1.6 million people who are not in the workforce, who were, if you go back a couple of years, when we were pretty close to full employment. And you've had this, what is that number? You've had about that number that have retired. So to bring people back in, it's going to be hard to see 500,000 jobs any of these subsequent months. There's 11 million job openings. You've got a labor market. There's just not enough people that can come back in. So you're going to start to see these numbers decline a little bit, but the unemployment rate, I think, is going to continue to decline. So it's, it's a white hot labor market. There's no other way to describe it.
Rick, is this as good as it gets? And where does it leave this Fed?
So I think it's as good as it gets from a labor perspective. I think the economy is moderating. I think you're seeing, when you look at some of the retail sales numbers that have come across globally, look at H&M yesterday, you're starting to see some of the data come off. You look at the housing market, boy, if anything was to suggest to you some form of stagflation, it would be in the housing market. So I think the economy, and this is part of why the Fed's in the toughest position that maybe I've ever seen them, is the economy starting to moderate in a bunch of ways. If you can't find the labor, and if your wage costs are going up, your input costs are going up, then companies will start to pare back a bit because you're seeing the consumer back off of these levels. So is it as good as it? Yeah, I think so. And this is why I think the Fed's got a tough job. And I think part of why I think it probably makes sense to get some 50s in when you've got an economy that's moderating. And I think they'll probably do that the next couple of meetings.
I hear some 50s. Does that mean 2? Or do you take the city view and go 3, 4?
No, I think you're assuming an awful lot to say you're going to go past 2. But listen, they're so far from neutral. They're still in super easy accommodative position that I think you got to assume that by the June meeting, you'll have gotten 100 basis points done. I don't think they're going to do an inter-meeting, but it's not impossible. But boy, I would argue, listen, get off of this easy. I mean, think about the last show, we were just talking about QE was ending. And if you think about, you got to get off of, closer off of the zero or close to zero where we are. And so I would, but then I think as we get into the summer, I think you've got to step back and look at what the data is doing. If anybody can tell me they know what's going to happen with the Ukrainian situation, what's going to happen with the Chinese growth situation, what's going to happen with European growth deceleration, these high prices, which tend to cure high prices as consumers pull back. Anyway, I think it's presumptuous at this point.
Would you fade any of these moves in this bond market? We've added some weight to the front end big time. You say no, why?
No, so the only thing I would do is people tend to focus on the flattening of the curve and the front end. They say, gosh, short end rates have moved higher. We've been investing in that 1 to 3 part of the investment grade credit market. So if you look at returns this year in fixed income, I think the AG's, after today, the AG's going to be down 6.5% or so. Things like long corporates are down double digits. Things like long treasuries down double digits. I actually like owning some, you got to keep your interest rate exposure down. Like, even though the curve's flattening, there's a concept of duration. There's a concept of, gosh, I just want to keep my return. If I can carry, the short end of the aggregate index is down about 2.5% this year. Down 2.5 is better than everything else. It's down 6 to 12%. So that's part of where we're, quote unquote, hiding for a bit of time. Get some yield, get some carry into the portfolio, and don't take too much interest rate risk. Listen, if we're going to get the next 3 months, you're going to get CPI prints that are going to show year-on-year CPI that's going to be 8-ish%. That's not going to give people any comfort around, a 10-year treasury that's at 240. So anyway, we're keeping our interest rate exposure very, very moderate here.
What about your credit exposure, Rick, specifically high yield credit?
So Jonathan, actually for the first time in a number of months, we've started to add a little bit. And, when you get high yield back at 6%, and, we like loans quite a bit because interest rates are rising. But, now when you get high yield back at 6%, it's pretty interesting. By the way, I always think the best valuation of the equity market is you take the free cash flow the companies throw off relative to the cost of financing it, i.e. where the credit market is. And for 10 years, equities have been too cheap. Equities are not too cheap anymore relative to where the cost of financing is, i.e. the high yield market, the investor grade market. So we've been adding a little bit, again, trying to manage the interest rate exposure, but we've been adding a little bit for the first time in a while. As you're getting back to yield levels, you say, gosh, if you go over the last 10 years and say high yield, it's 6s into the 7s, that's not a bad place to capture some carry. But again, I still think you can be patient.
Help me understand what that means for the cash position, because you had raised the cash position. Have you maintained that at existing levels? Did you use some of that cash to go into high yield, or did you rotate out of equities?
So cash is one of my favorite assets today, and it continues to be. I mean, you look at, somebody put a report out today that said this is the worst performance. You take the equity market, the debt market. I mean, this has been, you have negative returns across everything. Cash is a lovely asset in that environment. So we're still running a high level of cash. We've drawn it down a little bit, Jonathan, to your point, recently, to add a bit of this credit, a bit of investment grade, a bit of high yield. Still being cautious on EM, but maybe a tiny bit of EM in a couple of places. And by the way, this is U.S. and Europe. I think some of the European credit markets have become interesting. So, that being said, I still think rates have some room to go, and so we're still being cautious around how much we're buying today and sitting in more cash.
Can we finish on Europe? They just had a 7.5% CPI print, Rick. When I watched that coming and just thought, wow, never mind the Federal Reserve winding down QE. The ECB is going to be doing QE through to Q3. They've got CPI running at 7.5%, a deposit rate of negative 50 basis points. And Rick, I'm just trying to get my head around how much repricing we need to do in a fixed income universe if Europe's on the path back to zero on a policy rate.
So, Jonathan, think about how many years we were on the show together, and we talk about, can Europe get a 1% inflation rate? Think about the number you just described. It's pretty extraordinary. And listen, by the way, European growth over the next 2 or 3 years, we were just looking at numbers today. They could be on par. The way we actually looked at estimates, economist estimates. They show, for the first time that I think I've ever seen this, European growth the next 3 years on par with the U.S. My guess is there's some assumption you're going to see fiscal spend alongside of that in immigration, in defense, it's infrastructure, climate, et cetera. So Europe could grow and could grow nicely for the next couple of years. And you've got an inflation dynamic, meaning we have some more to go in Europe. I would argue from a rate perspective, thank goodness we're out of the negative interest rate scheme, which, as you know, I think is crazy to start with. But I do think we've got some ways to go. Listen, I think interest rates particularly in the U.S., the demographic and the demand, why are rates still where they are? Global demand for yielding assets for income is still pretty high. But, if you said to me, pick which side they're going, I still think particularly in Europe, I think rates have a bit more to go.
Rick, just finally from me, we have been talking for a long, long time. It does go back years. I see that the Total Return Fund won the Lipper Award for the best core bond fund over 10 years. I wanted to congratulate you and give you the opportunity as well just to talk about your team. Because, of course, it's not just about you. It's a team effort, a big team behind you over at BlackRock.
So you're very kind to mention that. And by the way, Bob Miller is who I know you have on the show a lot, is an extraordinary driver of that fund, and Dave Rogel. And it's it's a huge honor. It's one thing if you pick it right for a month or so, but Bob and Dave and I think as a team it's been a pretty good effort. So you're very kind to bring that up. And so anyway, I will say that was what has happened.
Yeah.
And there's no less work applied today to trying to figure out the environmental conditions to operate within in these markets.
Hey, Rick, here's to another 10 years. My best to you and the team. We appreciate it. Good friend of this program. Looking forward to years still to come. BlackRock's Rick Reeder there on his effort at the moment. Futures are positive by 0.25% on the S&P. A really decent jobs report behind us with some movers. Here's Abby.
John, well, a piece of that strength, not surprisingly, is coming from the banks on that strong jobs report. Yields popping sharply higher, especially that 2-year yield. And despite the fact that the 2-10s are inverted, as you've been talking about, banks, Wells Fargo, up more than 1%. Not killing the tech sector. Amazon off of its highs, but still up 0.4%, even though rising yields, as you know, could call into question Russian valuation. Speaking of higher China tech, take a look at Alibaba, up 7.1%. This, of course, as China is considering giving U.S. full access to audits that would, of course, provide more transparency to these companies and to perhaps take away the uninvestable question. And then finally, maybe as a barometer of risk sentiment, GameStop, meme mania, up 14%. Stock futures may be up modestly, but these meme stocks continue to go. Perhaps we'll see the indexes follow, John.
Abby, thank you. Coming up on the program, President Biden ordering a record release of U.S. oil.
It's time to deliver true long-term energy independence in America once and for all. And I'm going to continue to use every tool at my disposal to protect you from Putin's price hike.
That conversation up next.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
I think that it's hard to put your head around any narrative. Like, just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Today, I'm authorizing the release of 1 million barrels per day for the next 6 months, over 180 million barrels for the from the Strategic Petroleum Reserve. This is a wartime bridge to increase oil supply until production ramps up later this year.
President Biden tapping U.S. oil reserves in hopes of cutting gas prices. Russia demanding payments in rubles. But Putin easing disruption fears, saying the following: "We have complied and will comply in the future with obligations under all contracts, including gas contracts. We will continue to supply gas in the volumes and at the prices set in current long-term agreements." Your team coverage starts right now with Bloomberg's Maria Tadeo and Bloomberg's Anne-Marie down in D.C. Maria, let's start with you. Have we settled this one yet? Has it been sorted out on the gas prices, rubles, euros, dollars, what?
Well, you want to sort it, I want to sort it, and this has been a perennial question now for a week. And look, we now start to get some idea, we have some idea of what this is going to look like. What the Russians say is, we're not going to cut the flows into Europe. We're going to continue to honor contracts. We know that Gazprom, by the way, has never been in breach of contract, not even in the run-up to the invasion of Ukraine. But he says what's going to change is that from today, there will be a ruble bank account. So the impression that we get is that European companies will send the money in euros, and Gazprom Bank Remember, this is the one financial institution that has not been sanctioned, will then create two accounts for its clients, one to cash in the payments in euros, the other one would make allegedly that conversion into rubles. So there's two things to keep in mind here. One, of course, is that Russia still gets the money from the gas. Europe continues to buy this gas. And then secondly, the impression that I get is for as long as Gazprom is not sanctioned, there won't be anything that looks like an energy oil embargo. It is very clear that the Europeans want to keep that financial line going. And what we're seeing here is a lot of political grandstanding. But in the end, not a lot will change. The swap will be done, presumably internally by the Russian Federation.
Maria, that's the situation in Europe. AMH, let's talk about the situation in the United States. And welcome back. We've missed you. Have we settled this effort by the president? How well received has it been? Will it make a difference?
Well, it does seem to be making a little bit difference when you look at what's going on right now in the spot prices, right, Jonathan? When you have WTI off some 7% when this was announced. The issue really is, and I know you spoke to the special envoy for energy security, Amos Hochstein, is will this really bridge a gap, and then will drillers want to come back and actually want to produce more? That is domestic U.S. drillers. And the president really went after them yesterday, asking Congress to charge fees to these firms that have unused drilling leases on federal lands. So you could see a little bit of the tension, but we should notice, Jonathan, this is a massive drawdown in the SPR. It is absolutely historic, 1 million barrels a day for 6 months. Potentially, though, is this going to be enough? This 6 month gap, is this going to month? They say this is a wartime effort, and then domestic energy players will step in.
AMH, thank you. We'll catch up with you a little bit later. Maria Tadeo from Budapest for the election over in Hungary this weekend. Joining us now is iCapital's Anastasia Amoroso, PGIM's Mike Collins. Anastasia, first to you. RBC's Laurie Calvasina this morning said it's time to ease up on energy. Not outright bearish, but time to ease up on energy. Do you agree?
I don't fully agree with that, Jonathan. And I think energy really remains one of the better geopolitical risk hedges that we have. And if you think about oil prices, they have already eased up from some of the worst case scenarios. But I don't know if we fully ruled out the worst case scenarios from, let's say, the output from Russia. What if that's completely curtailed? I think the market is considering that we're still going to be receiving some volumes from Russia, but something like 70 or 80% of the volumes that are currently being exported, they're looking for a new home longer term. So I think that is still one of the better geopolitical risk hedges. Now, energy stocks have done phenomenally well, but in this environment, you know, with oil prices still continuing to be at $100 a barrel, and I think that's plus, and that's our expectation for the remainder of the year, these oil companies are going to be making very significant cash flow. And by the way, when I think about the current environment, you want to be in higher quality stocks, you want to be in dividend producing stocks, and that's actually what you find in the energy sector right now.
Mike Collins, that's the answer from an equity perspective. Can you give us the credit view?
Yeah, so Jonathan, we've been overweight generally the energy sector, including a lot of the pipelines, right, which are really the critical infrastructure to move the gas and oil around. And now we're exporting more and more of our energy, especially this liquefied natural gas, to Europe. So that infrastructure is really critical. I think we're just in the beginning stages now, Jonathan, of an increase in capital investment, an increase in production in energy in the U.S., right? What we've seen in the oil curve is, yeah, the front end contracts are coming down, but the curve is more evenly balanced. So that's actually incentivizing oil companies now to produce a little bit more. So it's actually a really good environment for energy credit investors because it just means more cash flow for more years to come.
Mike, where do you stand on credit risk more broadly? A lot of people have still been quite comfortable with that. Looking at the numbers from payrolls this morning, the jobs data looks fantastic. The American economy, for many people, looks robust, resilient. Do you fear the slowdown in the back half that some people do?
Absolutely. You know, Jonathan, the economy is red hot. The labor market is red hot. But all of those things always occur right before a slowdown, right? You get a flat curve, you get a really low unemployment rate. In fact, that's actually one of the best leading indicators of future slowdowns is a really low unemployment rate. You get really hot economies, and we are there, right? But I think we're just at the tipping point now, Jonathan, where we're going to see this inflation start to generate demand destruction, right? So I really think the second half of the year could be a lot weaker. And I worry about this first quarter earnings season, which, you know, begins in the next week or so. I think you're going to see more profit warnings, more profit margin warnings, more uncertainty, companies' inability to pass through those costs.
Goldman, David Costin talking about the same thing this week. Anastasia, we've got some more time around the opening bound, but just briefly, your view on the data and whether you share those fears that Mike has.
I would. I mean, we shouldn't ignore the data. And I think Mike is absolutely right that it's not just the yield curve that's really sending some red warning flags here. I think it's the fact that wage growth is not keeping up with inflation. You've got negative real wage that's coming through, and it's biting the consumer. And speaking of the oil markets, we're already seeing a slowdown in some of the oil demand this year, where seasonally it should be picking up. So I do have the same concerns about the data. I don't think the slowdown is imminent, but it should definitely be watched.
Anastasia Amoroso sticking with us alongside Mike Collins. The data absolutely stunning this morning. Fantastic. Slight miss on the headline number, but everywhere else, unemployment much lower than anticipated. Year-over-year wages looking decent, and the move in the bond market up 11 basis points on a 2-year this morning. Your 2-year 244, and your 10-year right now higher by 9 basis points to 243. Coming up, the morning calls, and later it's day one of Q2. Equities coming off their biggest quarterly decline since the pandemic. That conversation just around the corner.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
We stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
The jobs report in America looks rock solid, about 5 minutes away from the opening band. Equities are doing okay, up a third of 1%. That's the equity story. Here's the bond market picture, 2s, 10s and 30s. You'll notice the 2-year yield this morning trading above the 10-year yield. Post-payroll so much of the last hour. Right now, no different. 243 versus 242. Some curve inversion. That's the price action. Let's get you to your morning calls. We can kick things off with Citigroup upgrading Wynn Resorts to buy, expecting pent-up demand to drive a swift recovery in gaming throughout Macau. Your second call from Baird, downgrading Walgreens to neutral, seeing little upside amid weakening demand for COVID-related items. And finally, Goldman, downgrading Dow to neutral, highlighting the stock's recent outperformance and growing headwinds. That stock is negative 1.9% at 49.25. Coming up, looking ahead to Q2 after stocks record their first quarterly loss since 2020. I had to check that a few times. I can't believe that. The first quarterly loss going all the way back to the pandemic. Your opening bout to kick off Q2 is just around the corner. From New York City, this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Leaving behind a quarterly loss this morning, and good morning to you, with a monthly gain right at the end of the first quarter and kicking off Q2 with futures up 1/3% on the S&P, on the Nasdaq up 0.2% off the back of a really decent payrolls report in America. There's the opening bell, switch on the board and get to the bond market. Yields are higher, much higher. On a 10-year by 10 basis points to 244. On a 2-year by a little bit more, and some curve inversion through much of this morning, following that payrolls report. In the FX market, the dollar stronger, euro weaker, euro dollar down to 110.44, off by 0.2%, and crude lower again. A 99 handle, 99.17, and down a little more than 1 full percentage point. That is some of the cross-asset price action about 20 seconds into this session. Let's get you some movers. Here's Abby.
John, let's start out with that bond story. Those yields soaring, backing up, really helping out the banks. In particular, right now, we have the likes of Bank of America up more than 1%, Wells Fargo too. So the banks are really enjoying the fact that yields are higher, not hitting tech too much at this point. NVIDIA holding in there, up about 0.3%. China Tech really soaring. Baidu up 8.5%. This, of course, is China is considering giving the U.S. full access to audits, which would create more transparency into those companies. And then GameStop, we took a look at that earlier, soaring up 11%. It's not just the risk on mood, it's also the fact, John, as you know, that they are proposing their first stock split in more than 15 years.
Abby, thank you very much. Looking at this bond market move, up 11 basis points on a 2-year to 244, on a 10-year up by 10 basis points, the 2-year up just a little bit more. So we've still got just a little bit of curve inversion through much of this morning, then it turns positive, just a little bit. Let's just call it zero. So I stop wasting my time and going over this again and again and again over the next few minutes as we chop back and forth, above zero, beneath zero, and look ahead to Q2. Coming off the back of the first quarterly decline since the onset of the pandemic. It has been that long. It's been 2 years. Looking at this, here's Candy Lines.
Yeah, John, that quarterly decline for the S&P was about 5%. I guess the good news is it could have been worse because that was well off the lows we saw this quarter as we saw that late March rally. And actually 5% losses on the S&P 500 as well as on high yield credit in the U.S. are kind of the best you could hope for in terms of fixed income and equities when it comes to U.S. assets. Treasuries, of course, saw their worst quarter on record, 5.6% decline. And for investment-grade credit, they were down 7.8%. When you put all 4 of those categories together, it was the worst return collectively since 1980. Of course, I left one thing out there, John, and that would be commodities. That was probably the best place to have your money. A hedge against inflation, seeing commodities rising across the board, 20% for the ags, 23% for the metals. And of course, when you combine oil and gas, broader energy up about 47%. That's all the backwards look, John. When it comes to the forwards look, and I'll focus on equities here, and look at history, this was just the 9th time since the year 2000 that the S&P opened the year with a first quarter loss. Of the prior 8 years that happened, 6 of them actually saw rallies in the second quarter, gaining an average of a little more than 5%. So that could be a good signal, but the caveat here is in 4 of those years, the index still ended down on the year, John.
Katie, thank you. Some important stats there. Back with us, Anastasia Amoroso, Mike Collins. Mike, I want to build up on something you said about earnings for the year ahead. And it echoed something that David Kostin of Goldman Sachs said to us a little bit earlier this week. This is what he wrote. There's going to be a significant number of negative earnings surprises. In fact, you'll probably get a large number of pre-announcements in the coming weeks just before the earnings season. Can you weigh in on that, Mike, and where you think some of this is going to be concentrated?
Yeah, well, it's really a function, Jonathan, of the fact that something has to give, right? Either prices have to come down or demand has to come down or both, right? And I would guess by the end of the year, both are probably coming down. But companies are just getting to the point, this inflection point, where they're going to really have difficulty continuing to pass through these higher input costs, right? So they either stop producing stuff or they eat it in terms of profit margin. And I think it's going to be pretty widespread, but it's really the consumer discretionary side, right? If people are spending all their money on oil and gas and cars and food, they're not going to be able to spend money on discretionary items. So I think there's going to be a lot of pushback from consumers in those areas.
Anastasia, are you expecting the same pushback?
I am. In fact, if you look at one of the surveys that tells you what the small businesses are doing in terms of price increases and what the expectations are, they're still raising prices today, but in the next 3 months, they're not expecting to raise prices to the same extent as they have before. So I think that's exactly right, is between slowing wage growth for the consumer and, inflation that's starting to bite and the companies that are not able to raise those prices as they have done before. I think that is going to produce a margin squeeze for some of the consumer staples and for some of the consumer discretionary companies. And broadly, I also agree with Mike that I think we're going to be in this period where we're going to see slower economic growth. We're going to see Fed rate hikes, and all in, this is going to lead to an earnings downgrade cycle. We've already seen this, by the way. Again, if you look at the global earnings revisions ratio, it is dipped negative, and that usually doesn't flip back around very quickly. It usually lasts for a period of time. So I think that's going to be the story for the rest of the year. But I will come back to Q2 specifically, and I actually share the sentiment that we maybe are in for a better Q2 than we've seen in Q1 because we're going to see some of the reversals of the trends from Q1. But on earnings in particular, Mike is right. We have seen a great number of negative earnings per announcements, the greatest numbers since I think the fourth quarter before the pandemic or 2020. So with that, maybe for this particular quarter, a lot of that negativity is starting to be priced in, and we're entering a seasonally strong period for the markets. So I probably wouldn't fade this rally just yet.
What would you do at the index level, Anastasia? This is the first time that you and I have talked in quite a while where you don't sound as constructive on the story at the moment, ex-energy. What would you do with the index story?
Yeah, well, I think that's right, John. If you take a step back, and if you look at what the S&P has done since even before the pandemic or since the depth of the pandemic, this has been a very strong rebound in the markets. But if you look at all the headwinds that are building, I'm not saying they're imminent, but I think we're in this environment where it's just not easy anymore. You don't have an easy Fed and to propel the markets, and we have to contend with this growth slowdown. So I think we're going to be in an environment where we're going to have these periodic growth scares. I do think that it's too early to leave the market party, so to speak, because we know that the markets don't peak until months after the yield curve inversion. So you want to stay in this trade, but you probably want to de-risk it in certain ways. And so maybe that's a way to give up some upside and give yourself, through the options market, some protection on the downside. That's one way to think about kind of moderating some of your risk on exposure. But then on the index level, yes, I would stick with the energy trade. I actually do like the tech trade. A lot of people flee that just because the Fed is raising rates. But when we are going to a growth slowdown, you want things that have the highest margins and the stickiest margins. And that's actually the tech sector and software in particular. So you barbell that with some of the higher dividend payers. Rick Reeder likes cash. I think there's definitely a place for that in the portfolio. And I think Rick also made a good point is with rates rising and credit spreads widening, that does start to change the dynamic for what investors want to do. So I think some value is also starting to emerge in the bond market as well.
So this is the equity story and the earnings risk around the equity story. I wonder whether real rates will be a supporting factor in the years still to come. Citi's Robert Bucklin thinks so. He wrote this. He said the following: negative US real yield should prop up global equity valuations despite intense geopolitical conflict, GDP cuts, EPS downgrades, runaway inflation, monetary tightening. Positive real rates potentially coming into 2023 would make us less inclined to buy the dips. So the real rate story for him doesn't change until 23. Now, Mike, that's your world. Mike, what's going to happen with real rates through this year into next year? How are you positioned for that story?
Yeah, Jonathan, I think they basically stay negative for most of the rest of our lives, right? I think a negative, 0 to 1% real rate is actually normal in a world of tremendous demand, tremendous excess savings, tremendous demand for yield, aging populations. You're supposed to pay to store your money in short-term risk-free assets like you pay to store everything else, right? So the one thing that could happen is the Fed could overhike, which is very likely, and probably our base case, as inflation's falling, right? And then they'll have to chase it. So maybe get a short period of positive real rates, but I think the Fed will have to chase their tail and end up cutting in the years to come.
Mike, walk me through this then. So as this program is playing out and you're watching these prices of bonds down, yields up, are you itching to get back to the desk and buy them?
Yeah, so we were actually got pretty negative on duration earlier this year when we saw some of these really brutally broad CPI prints, Jonathan, and a real hawkish tilt to the Fed. But just in the last week or so, we've kind of covered that and gotten more flat duration. What people don't realize is when the curve is really flat, like it is now, what the average investor, especially retail investors, want to do, Jonathan, is move into the front end of the curve, go into cash or 2-year, because they think, wow, I'm getting the same ex-ante yield. Why would I take more risk? But the actual trade to do, Jonathan, in a flat curve environment is move out on the curve, add duration, because ultimately that flat curve will result in a steeper curve and you'll get paid to earn duration. I mean, in 3 and 4 and 5 years from now, Jonathan, I still think the funds rate is going to be coming back down and long rates are probably going to be lower than they are today. So there is already a lot of embedded value out on the curve.
Mike, every time we get a sell-off like this one, it introduces a conversation about whether the 40-year downtrend in Treasury yields or the rally in the bond market over multiple decades is over. What's the ultimate pushback to that from you?
We're right at the top. I was just looking at it this morning. I've been following this trend for my entire 3-decade career, Jonathan, and we've always stayed within that band. And right now, we're right at the top of that band. And we're seeing a lot of, I was at a big pension conference this week, and a lot of pension funds are looking at these bond yields, like Anastasia talked about, relative to the potential returns on stocks and saying, hey, this is a good time to rebalance, to sell equities here and go into bonds at much higher yields, much higher expected returns. We obviously see a lot of international demand. So I think there is a lot of pushback. As people get older, they need to rebalance and have more fixed income. So I think we're getting close to the high end of the range here.
I'm going to come back to this conversation in just a moment. Anastasia Amoroso, Mike Collins, sticking with us about 10 minutes into the session. Equities this morning on the S&P 500 shaping up as follows. On the S&P, we are a little bit positive, up 0.2%. Coming up, the war in Ukraine, jeopardizing the economic recovery.
I really believe we're underestimating the medium-term impact of this war.
That's coming up shortly. Plus, we'll catch up with the White House, the U.S. Labor Secretary Marty Walsh on the payrolls report.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Most companies have actually said that they believe what we did yesterday was exactly the right thing to do, and that they feel that it has an incentive because it is for 6 months before their production comes online, and because we're going to spend the next couple of years replenishing the reserve. That means that they are incentivized to continue to spend the capex that they've announced to increase production.
Amos Hochstein there of the Biden administration joining us a few hours ago on the crude situation. AMH joins us now down in D.C. Anne-Marie, a lot of pushback to this. Amos saying that some people in the oil patch are happy with it. Some really strong words from the president yesterday, and I'll run through them again and share them with our audience. Companies have an obligation that goes beyond just the shareholders, to their customers, their communities, their country. No American company should take advantage of a pandemic or Putin to enrich themselves at the expense of American families. Anne-Marie, that's some strong stuff.
It is strong, and I think, Jonathan, there's really 2 points to make here. One is that it's a complete 180 for this administration, a third drawdown from the SPR. This was a president who campaigned to make climate a pivotal sector of his entire campaign and wanted it to be part of his presidency. And in the second half, you do have a war that is going on. And obviously, Russia is such a massive commodity producer, especially in the oil and gas world, and that is adding a premium to the price. And the issue this administration has is it's just a too short of many months, Jonathan, until we get to November. And those gasoline prices are going to hit hard. Consumers at the pump, but also what Amos said in that interview is it's not just farm to table, it's farm to truck to table. The oil prices increases everything along the supply chain, and that is just hurting consumers.
One conversation we had, Anne-Marie, and I'd love your views on this talking point of the administration, and it is that, a talking point, of the amount of leases that some of these oil companies are sitting on. The way it's framed often is as if they're sitting on this really productive land with this very, very cheap oil that they can just get hold of and sell into the market. It's really not that simple at all. Why do they keep bringing this up?
Well, it's not simple, right? And Amos was fair about that. He said that not all the time you're going to have a very productive well, and you have to do a lot of digging, geology, seismic testing to make sure there actually is profitable oil in these wells to use them. On the other side, the administration thinks that if you're just holding on to these leases and you're not using them, then you should have to pay a fee. Why should you just sit on them? Either use it or lose it. And potentially, Jonathan, this might actually get some steam in Congress. And that's what the president was calling on yesterday. But it is a talking point for the administration because 9,000 sounds like a lot. The issue is, until you find out exactly how much oil are in those wells, it's going to be much less.
Anne-Marie, thank you. AMH, it's a nuanced debate. and I look to add a little bit more value to it, and I know you do too, and the administration in the coming weeks, months, and let's hope it's not years we're talking about this. Some breaking data just crossing the wires. Mike McKee breaking through all of it down in DC. Mike, put it together for us.
Awful lot of news, John. We've been talking about the fact that March was the month when the war started, and we're seeing some results. In the United States, better manufacturing news from the S&P Global, which used to be the market ISM numbers, PMI numbers, 58.8. Now, that's the final number. The preliminary was 58.5, so it went up at the end of the month. Not the same in Europe. You can see there that the PMIs there went down across the board as the month went on and as the war started raging. Then the big problem for the Europeans is inflation. The European CPI comes in at 7.5%. That is the highest ever, basically, for the Eurozone, and it's something they're going to have to really work on. The ECB's got a tough job ahead of it. And before I let you go, John, one more thing to note, that's the Chinese PMI. The Caixin came in below 50, joined the state PMIs below 50, suggests some contraction in the Chinese economy, not good for the overall global economy.
Mike McKee, I'm pleased you gave us the global view. Thank you, sir, because I want to get to Mike Collins on this. Mike Collins, 7.5% CPI in the Eurozone. A deposit rate at negative 50 basis points. They're going to be doing QE through to Q3 if their guidance is anything to go by. What changes for you in Europe?
You know, their GDP and their growth is slowing more quickly than ours, Jonathan, right? So I think the ECB has already kind of tipped their hand and indicated that they're going to focus probably a little more on the growth side of the equation than the inflation side. And I wouldn't be surprised if the Fed's in the same boat, right? At the end of the year, if inflation is still running at 7, but growth is tilting down toward 1, what does the Fed do in that world? I actually think that they probably start focusing a little more on the growth story and provide support. But for right now, I mean, they are singularly focused on inflation, and they're going to run hot, and they're going to keep hiking, right? I think there's a chance they do 100 basis point, hike in May and June. Why stop at 50, right? If you stop at 50, Jonathan, in May and June, by the end of July, when your third meeting comes up, you're averaging like a 0.5 point of Fed funds rate for almost 4 months. Between now and then, why not get there sooner?
Mike Collins, you don't get to say that and walk away. I've got 60 seconds left. You think they should go more than 50? Now, is that a should call or a will call? You think they will, or you think they should?
They could. I mean, their next meeting, May 4th, is a long time away, Jonathan. They have plenty of time to set up the markets for a more aggressive hike. Like I said, their third meeting this year from now is not for 4 months, right? So if they're doing 50 and 50, they're sitting here at 0.5% funds rate on average through most of the summer, right? And is that really where they want to be? You saw Jeff Rosenberg this morning say, yeah, the Fed wants to get ahead of this. That is not getting ahead of it, right? I mean, we're really short the front of the curve. So, I'm talking my book to some extent, but I think they're going to ratchet up the funds rate really aggressively here, and the curve's probably going to keep inverting.
Well, at least you're open about talking your book. I appreciate that, Mike Collins. And a special thanks to Anastasia Amoroso, to you both. I appreciate it. Thank you. A really solid jobs report behind us in the United States, and off the back of that, yields higher materially by 11 basis points on a 2-year at the moment to 244, on a 10-year also at 244, up by around about 10 basis points. Joining us now on Bloomberg TV and on Bloomberg Radio, U.S. Labor Secretary Marty Walsh. Secretary Walsh, what a jobs report. Just fantastic. Most people have come on the program this morning with Tom and myself and Lisa on Bloomberg Surveillance and on the Open have all said it looks great. What are you most enthused by looking at this?
Well, I think one of the things that I like is we saw an increase in labor participation rate. So one thing we spoke about this morning, a good, unemployment number low, a good strong report, good last 3-month report, actually a good last 11-month report, over 450,000 jobs. We think about moving forward into 2022, 1.6 million people still need to return back to the workforce. How do we get those folks back to work? How do we make sure that labor participation number goes up? Certainly, there's still jobs open in the United States. That's one of the things. I'm not taking away from the report. I'm very excited about the report. But I think we're thinking about here, how do we move forward? The second thing is we're also looking at, what can be done by Congress. We have the Bipartisan Innovation Act, other known as the CHIPS bill. That allows us opportunity for supply chain issues moving forward. We have some COVID relief money still being talked about at Upper Capitol Hill. They need to pass that because we're watching, I'm seeing what's going on in China and parts of Europe with another variant going up. We want to make sure that we're prepared for that here in the United States. And then obviously inflation. We're working the president is very laser focused on bringing the cost down. Lots of challenges there. You were just talking about global challenges there that we have in other markets. We have to, continue to work very closely on that. The Fed Reserve, they're going to take their action. I can't really comment on that. But we have to make sure that in the short term we do everything we can to reduce those prices, but also long term that it doesn't happen again. A lot of what we're seeing with inflation is due to the pandemic. Obviously, what we're seeing with Putin and what he's doing with Ukraine. But we also have to think long term. How do we prepare the country that we don't go through this again?
Secretary Walsh, I've only got a few more minutes with you because I know you've got to do a range of interviews. You're a busy man this morning, so I'll whip through a couple of other issues. There is a labour contract covering about 22,000 West Coast dock workers at sites including LA and Long Beach ports. That expires on July 1st. I know you're aware of that. I want you to help me understand what's the difference between those unions, those individuals behind those groups that represent them, using their leverage to secure better terms and exploiting the country's dependence on those ports. What's the difference?
I don't think they'll do that. I mean, I was out in Seattle and Tacoma, in Portland last week, specifically to talk to the company and companies about the negotiation a little bit, about how they feel about it in the unions, and express to both sides the importance of what we've gone through as a nation over the last 18 months with supply chain and challenges and still having ships out in the ocean. They all understand the importance of that. And I think I don't see either side exploiting the situation we're living in for better wages. The contract will begin negotiation at some point in the next month or so. I believe that's when it'll start. They have to do some notification piece, but I'm going to monitor the situation very closely. Obviously, I want to make sure that we don't stop our ports. I mean, the last thing we need in this country right now, or in this world, quite honestly, is shutting down other supply chain and creating other supply chain issues.
Are you going to step in?
If I need to, I will. I said to both sides. I mean, I don't think I have to step in at this point.
Sure.
If I did, I'd be having a very different conversation with you. But I think, I feel good where the conversation is with the sides right now. I think that they all understand the magnitude of this particular moment. This is unlike any other moment they've ever had when it comes to negotiations. Still coming out of a pandemic and, moving forward, all these issues around this. So I think they acknowledge very seriously the situation this country is in, and quite honestly, our supply chain is in.
You've been to those ports. You travel a lot. I believe it's 60 cities in 30 states during your first year. You know where I'm going with this. You've also been really criticized because you've spent 162 days in Boston out of your first 284 days in office. Secretary Walsh, this comes up often when you and I talk. It keeps coming up. People keep talking to me about it.
Yeah.
Why is that? What's in Boston?
I think it's a ridiculous argument and a ridiculous point that's being made. In the very beginning of me being Secretary of Labor, we at the Department of Labor, where I'm standing in front of right now, nobody was in the office. We were shut down because of COVID-19, and I was doing my job. I was traveling around the country. Yeah. Some of those numbers that are reported, I go home every weekend to Boston. I'm going to continue to go home to Boston every weekend because I have a mother that's there and I have a family that's there, and I've made it very clear from the very beginning. So I think when that article was written and that reporter put those facts in, she's incorporating the weekends into that. And if she took those out and actually did an accurate account of what happened, they would tell a very different story.
Well, Secretary Walsh, I've got a mother in London. I've got to be in New York. That's what happens sometimes. People are basically asking why you haven't chosen to live in Washington, D.C.
I do live in Washington. I'm in Washington.
You've got a permanent resident there now. You've got a permanent residence there in D.C. now. Just yes or no?
I'm living out of a hotel.
Okay. Secretary Walsh, we've got to leave it there. Thank you for being with us, sir, as always. From New York City, with your equity market doing okay off the back of a pretty decent payrolls report. And don't ask me, that conversation keeps coming up with Secretary Walsh, and he's a very good man for responding to it. This was the countdown to the open. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venagold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venagold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venagold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venagold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
He has a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent
and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us. The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse. How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa! Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. But while that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition